Good morning, ladies and gentlemen. Good morning, good morning. And welcome to the Marriott Downtown Hartford for year 2 of Insuring the Future. My name is Conor Geary. When I'm announcing for the basketball capital of the world, I go by the name Game Day Conor. I promise here today in front of the insurance capital of the world, Conor is perfectly fine with me. I'll accept that. Today promises to be a fantastic conversation where we welcome professionals, subject matter experts, to have an open and honest conversation geared towards sharing insights and fostering collaboration and highlighting best practices to our end goal, which is insurance solutions on climate resilience and, of course, community impact. So it's a great privilege to be here with you, emceeing this event throughout the day. It's an honor to be here. And I look forward to learning a lot and hearing from many of you about ways that we can make that impact in our community, facing the realities that we have before us. At this time, I would like to welcome up for some opening remarks the Commissioner of the Connecticut Insurance Department. Please welcome Commissioner Andrew Mais. I am not Commissioner Andrew Mais, just for the record. It's an identity crisis for a moment. He'll be here in just a moment. He's outside waiting for one of our guests to join us today. In the meantime, I want to dole out some thank yous. I'd like to thank the Metro Hartford Alliance and their CTIFS initiative, Insurance and Financial Services. A round of applause for Metro Hartford Alliance and the team that I think helped you register in there as well, too. I didn't know I was going to be up there. I would also like to thank the Connecticut Insurance Department for helping to put this on and hosting this important conversation. As I mentioned earlier, we're going to be talking a lot today and have panel conversations, have a dialogue, and hear from a lot of folks who have expertise in various fields, ensuring, pun intended, that the goal is to walk out of here better informed about ways that we can prepare, ways that we can make sure that certainly this industry is better prepared for the climate realities before it. I want to say a note to those that might be here for the educational component before and after the panels. Just a reminder, in order for you to claim the credit, there's going to be a QR code up on the screen for you. It'll be important for you to scan that QR code, to fill out the form that is available to you, and then you also need to make sure that you sign out at the end as well. So I need you to scan that QR code at the beginning and scan that QR code at the end. I want to thank, and we'll do this a little bit later on, the sponsors who are in attendance today for helping to make this conversation possible. We'll be recognizing you throughout the day, but as I wait and do my very best job at paddling above water before Commissioner Mais comes up on stage, I want to recognize you for your contributions and your support as well, too. There are some realities that we have seen in terms of climate and weather patterns. Certainly we've felt those here in Connecticut as well, too. We've seen some flooding. We've seen, the smoke from wildfires that have really blanketed the country as well, too. And these realities that we have to face are becoming more and more regular, and so it's incumbent upon us to understand ways that we can secure and ensure and protect against that. And one of the things in learning about this dialogue today that I was really most certainly impressed by and proud of as well to participate in this is recognizing that there are underserved populations, that it is, I'd say, our job. I announce games for a living, so I'll take a little bit of responsibility, but it's really the job of the insurance department to make sure that those communities are well served as well, and making sure that financial losses and claims that might be associated with some of these more frequent, more devastating climate and weather patterns that we see really do not in a disproportionate way affect those who might be disadvantaged and have fewer privileges than some of the other neighborhoods that we might live in. I'm getting the 2 sign. Does that mean he's 2 minutes away or 2 months away? Which is it? I'm just figuring that out. 2 minutes? Perfect. I've got a 2-minute warning. A 2-minute warning I'm used to. I can do that as well too. Normally I would have t-shirts to throw out at this point and make a lot of you happy and the other half of you very, very mad at me. But I think I can make this happen for 2 minutes. Is this anybody's first time to the conversation? Yes, welcome. If your hands are down, I imagine it's because you were here last year. Who was here last year for the conversation? Welcome back. I hope you found it insightful. It's great to have you back again as we kind of see how this conversation evolves year over year. Am I getting the high sign? How'd I do? Honestly, how'd I do? I didn't even have a script for this. It's like 6 minutes, right? Come on. I'd say without further ado, but you know, we've played that. Please welcome to the stage Commissioner of the Connecticut Insurance Department. Almost ready? 30-second warning. With a long, drawn-out, resounding, resilient, loud, early morning downtown Hartford round of applause, Commissioner Andrew Mais. Thank you, Commissioner.
Apologies for the slight delay. I was so thrilled to be here that I was skipping, couldn't quite make it in here on time. But I just want to say good morning, everybody. Thank you for being here. I'm, as you just heard, Andrew Mais, Commissioner of the Connecticut Insurance Department, and it is an honor to welcome you to what is the 2nd annual Insuring the Future Summit, but actually the 6th straight climate event that we at the Connecticut Insurance Department have hosted. We are proud to co-host the summit, bringing together experts, leaders, and innovators from across the insurance industry and beyond. This is Hartford. We are the insurance capital of the world, and it is up to us to take the lead on addressing the risk caused by climate change. I'm glad to see so many people here in the room today. We've got various stakeholders, we've got students, we've got legislators, we've got members of the executive branch, we've got industry, we've got academics, we've got consumer representatives, and that is important because only by working together will we be able to address this risk. Climate change is already affecting the risks we insure, and it's no secret, its impacts are already being felt by our communities, our businesses, and public infrastructure. Now, insurance, as we all know, is a tool for resilience. It enables communities to recover from disasters, but also by moving up front, by doing mitigation, we can reduce economic loss, and we can give residents and businesses the confidence that they can weather extreme events. We know they're coming. We know more of them are coming. We know we must be prepared, and that is why we are here today. We understand that protecting people from climate-related risks requires foresight, planning, and collaboration. Innovation and technology are transforming the way we assess and manage risk. From parametric insurance to advanced climate modeling, data analytics are helping us understand exposure in ways we never could before. These tools help insurers to design products that better meet the needs of residents and businesses while, and I'm going to keep coming back to this phrase, supporting more resilient communities. I'm up here and I've got the mic, so I'm going to take a moment now to highlight a new initiative that I'm really proud of. It's an initiative from the Insurance Department here, and we've got a number of Insurance Department staffers. Everybody's worked together on this, and it exemplifies the type of approach that we think needs to be taken to properly manage climate risk. We recently launched, if you go to our website, ct.gov/CID, we launch a free, easy-to-use online mapping and risk-related tool that allows Connecticut residents to assess the risk from flooding, wildfires, heat, and hail at their specific properties. We're using First Streets, and they're a nonprofit, state-of-the-art platform. And you can go on. You enter your address, and you immediately see visual maps and property-specific risk reports. This tool provides a marked improvement over the static flood maps that have long been relied upon, and it helps homeowners and businesses make more informed decisions about protection, about mitigation, about insurance. We saw the need for better risk assessment last year after the catastrophic flooding in parts of Western Connecticut. Many of those residents that were affected did not have flood insurance because they believed they were not at risk. Well, I think those of us in the insurance industry knows, we all know if it rains, it can flood. We need to make sure, and what this project will do is ensure that Connecticut residents have better access to the information they need to protect themselves, their families, their communities, and this great state. Again, the tool is available. You go on our website. It's at our Flood Information Center, and we certainly encourage you to try it. Let us know what you think. Let us know how we can make it better, because this is part of what we are here to do. This is part of what this governor, this lieutenant governor, this administration is here to do. We are here to ensure that every resident of Connecticut has the information, has the tools to address these changing risks. That's also what this year's summit is about. It brings together an exceptional lineup, and if you've looked through the list of speakers, I don't know how I got into it, because, you know, compared to some of these people, you look at some of the people that are just stunning in this field, and it will cover a wide range of issues at the intersection of climate, innovation, and insurance. And that means the latest on public health, for instance, on climate science, on housing, on risk modeling, and on sustainable investment strategies. Again, Connecticut is proud to lead on these issues. We recently, and I see my co-chairs over here, we recently convened the Extreme Weather Mitigation and Resiliency Advisory Council, and we brought together experts to develop recommendations for programs that make homes and businesses more resilient to flooding, to extreme weather, to climate-related risks. Now, the council delivered its final report with actionable steps, and I can't stress how important this is. So I know how I react to stuff. You know, you're going to tell me that, okay, this might happen, but if there's nothing I can do about it, I'm going to close my eyes and just walk away. That's why this report has actionable steps that we all can take to help reduce economic losses, to keep residents in their homes, and to support a more competitive, a stronger insurance market. And I'm glad to be able to say you will be able to hear from our co-chairs today. They will give you more information on that. And it's not just about risk management, it's also about opportunity by working together. All of us in this room, as I mentioned, people we represent, government, industry, academia, the public, we can foster innovation and thus protect consumers and support sustainable growth. Collaboration is the key to ensuring that Connecticut continues to remain a leader in insurance, in climate resilience, and in innovation. We've got a really exciting program ahead. It's a unique opportunity to learn from each other, spark ideas, strengthen the networks that will allow us to face the future challenges together. So, thank you for being here today. I look forward to the conversation, to the insights, to the solutions that will emerge from the summit as we continue to innovate. But first of all, I have to tell you, I'm looking forward to hearing from, and I'm honored to introduce, the Lieutenant Governor of our great state, Bysiewicz. Lieutenant Governor Bysiewicz, I'm going to read your bio here for a second, is now serving her second term as Connecticut 109th Lieutenant Governor. Everybody who knows her knows she has been a dedicated leader in addressing the impact of climate change on our state. Her work has helped advance initiatives like the Governor's Council on Climate Change, its targeted working groups, and the development of a comprehensive energy strategy. And these efforts are reflected in reports such as Taking Action on Climate Change and Building a More Resilient Connecticut for All, underscoring her commitment to protecting our communities and building the long-term resilience that we as a society need. So please join me in welcoming Lieutenant Governor Susan Bysiewicz.
Commissioner, thank you so much. Good morning, everyone. I'm so glad to be here for the second annual Insuring the Future Summit. You've heard that we are indeed the basketball capital of the world. We are also the pizza capital of the world. Stay tuned. Tomorrow we announce our pizza trail, and that will be the top 100 pizza spots in our beautiful state. Take that, New Jersey and New York. And of course, we're the submarine capital of the world. But we're here today because indeed we are the insurance capital of the world, and there is no better place to hold this summit than right here in Hartford, who has hosted that capital for more than 100 years. Today, we are bringing together regulators, industry experts, academics, and advocates to together tackle some very tough issues. The challenges are real. We've seen in our state climate change, wildfires that burn for days, superstorms that level homes on our shorelines, or 100-year-plus floods that happen every year. So we have so much to talk about: rising healthcare costs, housing pressures that are hitting our families and our communities every day, and of course, there's a lot of uncertainty about how federal programs and funding, or the lack thereof, will affect our state. So today, what's exciting about what we are doing is that we are focusing on solutions, from building more resilient communities to using better data and compliance tools to creating new products that meet our risks. Insurance plays an important role in protecting people and families, supporting investment, and keeping our economy here in Connecticut strong. So I want to say thank you to our Commissioner, Andy Mais, to Connecticut, IFS, Cognizant, and all of our sponsors who made this summit happen today. And with that, it's my pleasure to introduce someone who's been leading the way on strengthening our economy, protecting our families, and preparing our state for the future, our fearless leader, Ned Lamont.
Thanks, Susan and Andy. Good morning, everybody. Sorry to be a few minutes late. Want to see if the voice of the yard goats could filibuster. I think he did a pretty good job. You're going to go to the U.S. Senate. You can waste some time down there. And Susan mentioned insurance capital of the world and pizza capital of the world. A little cheeky, the pizza capital of the world. I did hear from a number of Italian mayors who thought that may be a little aggressive, but, you know, I said, come visit. We can prove me wrong. I'll pick up where our amazing Commissioner Andy Mais, left off. Somebody recently said that climate change is a con job. Well, mentioned that to the farmers I saw in the Connecticut River Valley a couple of years ago, who had been really worried about severe drought conditions. And 5 days later, their crops were a foot underwater. And we were working hard to get them some low-interest loans, and they said, we're still paying off the low-interest loans from the last 3 floods. And that's how we're thinking about what we could do to make sure that's a little less likely to happen again. Andy mentioned, down in Naugatuck Valley and Oxford, the severe, sudden, shocking flooding where, you got an electronic notice that there might be a rainstorm, and then you're standing, 1 foot underwater in your store, and you got a notice, watch out for the flooding. And, as Andy said, I was just really shocked that none of those homes, none of those businesses had any flood insurance because they were not in the floodplain. So we've put in place some efforts that Andy said. We're going to take a second look at the floodplain and revisit that and make sure that people have the very best information they need so that they know what risks they are when they build where they are or where they buy where they are. I've got to believe that artificial intelligence will be a big piece of that mapping, years to come. So we're doing a little better than saying, boy, we haven't had a 50-year storm like this in 25 years. We'll be a lot more exact, a lot more personalized in terms of insurance, block by block and home by home. And I think I saw Rob Hodling here, helping take the lead, working with you, I hope, in terms of give us advice on how we can rebuild these homes better. Sale is here, our Commissioner of Housing. Where would you give people incentives? Where would you give them bonuses if they rebuilt or fortified their homes to make them a little less likely for flooding, for example? Help us think about that. We're rebuilding our roads up, an extra 2 feet higher. We're rebuilding our bridges an extra 3 feet higher because the little river down in Oxford, all of a sudden trees are getting poured through and they're tearing apart our bridges. Give us some advice. Give us your very best thoughts on where and how we can rebuild as a state and as homeowners in terms of resilience. This is something we need to do together, and I'd like to think that each and every one of you have the expertise to get it right. And we as a state, need your input and your advice. I think Brian Garcia is going to be coming to speak a little bit later. He runs something called the Green Bank, where we provide financing for many things, including resilience. But you tell us how you would define resilience. You tell us where we get the most bang for the buck. And you tell us where those greatest risks are. We need your assistance there. We have a lot of electric substations that almost went underwater during Hurricane Sandy, and so we're raising those particular substations. But if you think about our infrastructure and our electric infrastructure, give Eversource some advice as well about where you think those risks are and what we can do going forward to mitigate those risks. We're trying to do everything long-term in terms of climate change and trying to reduce our carbon footprint. I was just out at Millstone yesterday trying to get another extension on that carbon-free, always-on electricity from the nuclear power plant. But we as a state can't do this alone either. We need the support of the federal government. Right now, they're not there. If they, reduce those clean air standards, all of a sudden the acid rain coming up from West Virginia is going to be decimating us again. But on a happier note, let's see what we can do together, how we can work together, how we can use AI to be a lot more precise about where those risks are, what we can do to mitigate wildfires and flooding and droughts, and the ways that we can make that just a little bit less likely. And as Andy said, thank you, on behalf of the state for what you do. Giving people a little bit of security, a little bit of confidence that we can mitigate some of those risks that gives them more confidence in the future. Thanks, everybody. Great to be back.
Thank you so much, Governor Lamont and Lieutenant Governor Bysiewicz. It's really reassuring to hear that we have informed, passionate leadership at the state level, looking ahead, looking to make commitments, utilizing technology to ensure that the planning going forward has that block-by-block mentality. That's really nice to hear. At this time, I'd like to welcome to the stage to give her opening remarks from CTIFS. Please welcome Susan Winkler.
Good morning, everybody. On behalf of CTIFS Board of Directors, thank you for joining us today at the second annual Insuring the Future event. I have a special thank you to Amanda, Jen, Kate Lewis, and all my colleagues at Metro Hartford Alliance for your tireless efforts in putting together the summit. I want to have a big shout out to the CID team, Alex, Anna, Mary, and everybody else for a great partnership once again this year. I'd like to say also thank you to title sponsor, Cognizant, and also future talent sponsor, RVI Group, who is here for the first time. I want to say thank you to them for that sponsorship, and to Jim Bedard, former chair of CTIFS, who brought a team together, but with that also welcoming Western New England, UConn, Yale, University of Hartford, Quinnipiac, CCSU, and others. Let's give a round of applause for our future talent sponsor and students. And of course, all the sponsors who, without their support, we would not be able to host this world-class insurance event here in the insurance capital of the world, and for Commissioner Mais, the insurance capital of the universe, as he told me last night. We're expanding. So what is today's conversation? Why does it matter? Why does all the information you just heard, and why is it the U.S. right now, both insurers and regulators are turned towards climate matters and all looking in the same direction? So I'm going to give you some of the data. You heard a lot of the anecdotal reasons and things that have actually happened. But here's some data, and this data this year is coming from Alchemy Crew in Verisk. So did you know that this is the new, average annual insurance losses for cat losses for 2024 is now $152 billion. So it was $100 billion and it was going up, and the new number is $152 billion for 2024. The frequency perils now account for 2/3 of all those losses. And in the first half of 2025, just the first half of this year, 18 of 19 of the $1 billion losses were all in the U.S. So of all of those natural cat losses, 18 of 19 of the $1 billion, those over $1 billion, were in the U.S., which is why we're here talking about this today. And of course, we can't go over the data without also thinking about those that are uninsured, and with the LA wildfires, less than 40 billion were insured. So that's also an issue we're talking. Today we'll hear about the top experts from around the US on how to manage this new normal. So what do we need? Do we need more mitigation technologies from insurtechs? Do we need incentives? We talked about incentives a minute ago for insureds, us, for protecting our properties. Is that going to make us do some more things to be prepared by giving us incentives? Do we need more transparency in models and regulations? Or maybe we just need more time, understanding, and patience to have the folks that are running the public and private partnerships and are managing future risks, give them time to manage those risks for the insureds and the uninsured. Maybe we'll find the answers today. But before I introduce the next speaker, I'm also really excited to tell you about a new enhancement to the program. So there are two environmentally conscious artists here today. They're in the back of the room. I see them now. I'm going to read a little bit about them. Max Giggle, his photography focuses on the details of everyday life to create human-centric narratives. His work highlights both the beauty and impertinence of the world, prompting reflection on humanity's relationship with our environment. Using vivid color and strong composition, he balances close detail with expansive perspective, offering viewers new ways to see meaning in both the personal and the monumental. Abhijit Shrivastava, who is here today, who I met at Climate Tech in DC and happened to purchase something there. He is Global Manager for Sustainable AI Infrastructure at Microsoft. That's his day job. And he's an award-winning climate artist using biochar, which is a material that uses carbon. His artwork portrays striking visual narratives that raise awareness and inspire action. Each purchase of his work supports farmers, improves soil health, advances sustainable practices, making his art not only visually powerful, but also a tangible act of climate action. So please take a moment today to look at the artwork in the lobby. These artists are here to inspire and deepen your understanding and commitment to the sustainable world, in addition to everything you're going to learn and listen to today. So I hope you enjoy that. At this point in time, I would like to introduce another very special guest, client partner from Cognizant, Poornima Varadhan.
Thank you, Susan, for the intro. Good morning. It's a privilege to be here in Hartford, the insurance capital of the world. It's going to be very soon universe. And to open this important event alongside Governor Ned Lamont, Governor Susan, Commissioner Andrew, Susan Winkler, and so many distinguished leaders. Cognizant is honored to be the title sponsor of this incredible event. The state of Connecticut and the city of Hartford are deeply embedded in our business and our story. We are a New York Stock Exchange listed company with $20 billion in revenue and global workforce of 300,000 across 40 countries. While we serve many industries, we are a largest provider of technology and operation services for the insurance and healthcare sectors. Our roots in Connecticut run deep. The genesis of our insurance business was Hartford. Of our 45,000 employees in North America, 5,000 are based here in Connecticut, working closely with insurers. This moment is personal for me. I have lived in Connecticut for 10 years and raised my daughter here. I have been with Cognizant for 23 years, most of the time serving insurance customers globally. There is truly no better time or place than to now speak about climate and risk in the state of Connecticut that shaped my life and career. Climate change is no longer a distant concern. It's a present reality. It's shaping underwriting, claims, customer expectations, and lives. As insurers, technologists, and policymakers, we must respond not just with coverage, but with courage. That's why Cognizant is investing in AI as a catalyst for climate resilience. Under our CEO Ravi Kumar's leadership, we have committed $1 billion to enterprise AI, launched the Synapse initiative to upskill 1 million people, and led the world's largest generative AI hackathon very recently. We also joined the White House AI Education Task Force, pledging support to help thousands of teachers and students to build AI literacy by 2028. We are also investing in climate analytics, ESG platforms, and AI-driven solutions that help carriers anticipate risk and build resilience. Beyond business, we are deeply invested in outreach, supporting workforce development, digital literacy, and inclusive innovation. Our initiatives underscore the core principle: technology must serve as an enabler, not a barrier, and resilience should be embedded not only within systems, but across communities they support. These investments are driving real impact, helping insurers simulate climate scenarios, personalize protection, and predict risk with precision. As our CEO often says, AI is not just about automation, it's about augmentation. It's about empowering underwriters, agents, claims professionals, regulators to make faster, smarter, and more equitable decisions in the face of uncertainty. Today's agenda reflects that urgency and ambition. We will explore how public-private partnerships, data innovation, and inclusive design can help us build climate-resilient communities and close the protection gaps. This isn't just about adapting to a change, it's about shaping it. Thank you again for the opportunity to be part of this dialogue. We look forward to the conversations ahead and to building more resilient, inclusive, and a climate-ready Connecticut. Let's get started. Thank you.
Thank you so much, Poornima. At this time, we're going to welcome up to the stage our first panelists of guests for a fireside chat. And this conversation is going to focus on exploring the investments available for sustainable and resilient communities as we bring together experts who are going to be talking about insurance, climate advice, as well as education, housing, and outreach as well. Moderating this conversation will be Commissioner Andy Mais, please.
Good morning again, everybody. It seems like just a minute ago that I was up here. And I'm thrilled to welcome you back as we start the day, which we know is an important day. Now we're going to turn our focus to an important part of the conversation, and that is how do we build and finance resilient, sustainable communities. If you look at this panel, this great panel brings together experts from housing, finance, and insurance to explore concrete ways that public and private investments can strengthen resilience, especially for communities that are most vulnerable to climate impacts. We'll discuss strategies, tools, and partnerships that are making a difference today and look at what it will take to scale those solutions in the future. Now, before we dive in, well, I want to thank our Emcee, who's been great, and I never thought I'd say that, but about anybody associated with the Patriots as a Giants fan, just so you know. All right, it's out on the table now. But let's give our panelists a chance to introduce themselves, and if I could start right on my left, and we'll just go down the line.
Great, thank you. Thanks very much. Hi, everybody. My name is David Erickson. I head the Community Development Department at the Federal Reserve Bank of New York. And the comments that I'm going to share with you today are my own. They do not represent the bank. Our new president started about 6 years ago, John Williams, and he looked at the mission statement, which said, Federal Reserve Bank of New York executes monetary policy, we're central bank of the United States, and regulates banks. Those two things are true, but he says that's neither accurate nor inspiring. We really do try to foster an economy that works for everyone. That's the goal of the Federal Reserve. And in that effort, we have a community development department that really looks at the needs of low-income communities from multiple angles, including the ways in which we can invest about the $500 billion that's invested every year by banks into low-income communities. If you add on to that the incentives in the tax code, the investment tax credits and the block grants, local sources like tax increment financing, bonds, and things like that, you probably get to another $250 billion. So it's about $750 billion a year invested in communities, and we would love to partner with you on how we can invest that money more wisely to make those communities opportunity rich, but also resilient to climate and healthier.
I have a lot of ideas. Good morning, everyone, and thank you, Commissioner, for inviting me. I'm Seila Mosquera Bruno, Commissioner for Connecticut Department of Housing, and our mission is to ensure that residents in Connecticut have access to quality housing regardless of their income levels and regardless of whether rental housing or homeownership, and especially we're trying to make sure that we build in communities that are resilient, in communities that are out of flood zone. Or if they were in a flood zone, we're actually rebuilding some of those communities, getting out of the flood zone, and I'll explain a little more after
when we enter into the conversation. But I do have a lot of ideas for the money that he has. And because the governor and the legislators have put significant amount of resources in the past. Since 2019, we have completed about 14,000 units and investing more than $600 million from the state funding that have generated about $2.4 billion in other public and private investments. Right now, we have about 7,000 units under construction, and some of those units are on some of the previously flood areas, and now they're out of the flood, so that they can be resilient and provide the quality of housing that our residents need. So looking forward to continue conversation.
Hello, I am Dr. Sarah Kapnick. I am the Global Head of Climate Advisory at JP Morgan. Same caveat, these comments are my own, not the bank's. And I provide advisory services around climate science and technology, what we see today and what we expect into the future in terms of science, in terms of tech, in terms of regulation, in terms of geopolitics. And this is all informed by my long career actually prior to the bank, working at the National Oceanic and Atmospheric Administration, most recently as the chief scientist. So I'm the chief scientist within a bank, helping people advise what's to come and what to expect.
Hi, my name is Joe Pursley. I had the insurance asset management distribution business for an asset manager called Nuveen. Similar to everyone else, these comments are my own today. But if you're not familiar with Nuveen, we are a $1.3 trillion global asset manager who's wholly owned by TIAA, which is an insurance company started a little over 100 years ago now by Andrew Carnegie to help America's educators retire with dignity. When we think about engaging with insurance companies in the US, we really do that around two core pillars. The first one centers around an insurance company's evolving strategic asset allocation and how they are thinking about solving tomorrow's problems from a balance sheet standpoint. And the second one is around what we would call all things sustainability. And that's coming in, partnering with an insurance company, helping them think through governance structure through a sustainability lens, if that's an area where they are, also helping to think through ESG risk factors that may sit within their balance sheet, and importantly, starting to think about how they can track and grow impact investments and non-financial KPIs that track towards the positive benefit of society and the environment.
Well, welcome all, and I do have to tell you, I remember this is almost a reunion because a number of us were on a panel at Yale that Brian from the Green Bank moderated. Then I had to answer questions. It's a lot easier to just ask them. But we've got some great people here. David, you're with the Fed. And by the way, I do have to say thank you, just so you know. David's got a flight to Chicago. So he came in, he's got to run, but he thought this was important enough to be here, and we really do appreciate that. Let me ask you, we're talking about vulnerable communities. Yeah. These are the communities that are, for various reasons, mainly historical, most vulnerable to the effects of climate risk, but also most likely to not be able to have the economic resources to address that climate risk. How can we better direct investments towards resilience and equity in those vulnerable communities? You know, what are the barriers? What are the opportunities?
Sure. And I think, you know, one of the ways in which I think about this is, and I think it might be apocryphal, but it is, you find in many sources that Dwight Eisenhower used to say that when he comes up with a complex problem, what his first impulse is to make it bigger. Because if you make it bigger, you start to see patterns that you might not have seen before. And so I think that's part of the key to that question is this problem is bigger than any one sector. And you all were on that panel to discuss this book, actually, you know, at Yale not too long ago, which was a joint effort between the Federal Reserve Bank of New York and two of the largest nonprofit banks in the country, the Local Initiative Support Corporation and Enterprise Community Partners. And in that, and I know you can't see this, but these are heat maps here of Manhattan and the Bronx. And it's basically through three lenses. The first lens is through health and the best summary statistic for health. And you can, if you Google this, what's possible investing now for prosperous, sustainable neighborhoods, You'll see it's on page 357. So this is the, and on this map, you'll see in Manhattan that life expectancy is quite high in the sort of lower area, Greenwich Village, West Side, East Side. But as you move into Harlem and the Bronx, the life expectancy begins to drop. And there's just worse health there. And if you look through another lens, an economic lens, and this we did percentage of people living in poverty in those neighborhoods, but we could have picked other variables. It could have been overcrowding in housing. It could have been access to a bank branch. It could have been income. You see the same map. It looks exactly the same. The heat map looks exactly the same. And then we look through an environmental lens. And we looked at heat islands. Where is it hotter on a hot day in New York City? And it turns out it's Harlem and the Bronx. Finally, air quality, same. And so, and thank you, Commissioner Mais. I am running to Chicago. If I missed that flight, it's at 12:30, so it's kind of close. I have a similar set of maps. I'm going to give a similar talk in Chicago to a group called Neighborhood Economics. These are all very small neighborhood groups, churches, nonprofits, community development corporations. That's who I'm speaking with tonight. And I have the same map of Chicago that shows the west side of Chicago and south side of Chicago with the same level of the same overlapping vulnerabilities in economics, in health, and in climate risk. And in anywhere you go, and Sarah and I were having this conversation earlier that she's done a lot of the mapping on this in places like Dayton to Philadelphia to New York. She, as a scientist, knows this is true everywhere that you look. And so that has got to be sort of the cornerstone to what we do moving forward, I think, is to try to find those. If we have shared risk, we should have shared value. And if there's shared value, there should be a business model in there somewhere where we can co-invest with these different entities, whether it's health, climate, economic opportunity, to create new business models that go upstream to tackle the root of the problem, to make those places more resilient. And so I think that's the key, but we don't really know how to do it yet. We're not really quite there, and that's why I think conversations like this are so important.
Thank you, David. Commissioner, you've mentioned some of what you've done. You're a national leader in getting resources to communities that have been affected. In addition to what I just asked David, what have been the best practices that you've used to ensure that these communities are not just the beneficiaries of the investment, but decision makers, that they have ownership in this?
Yeah, sure. My background is was as the CEO of a nonprofit affordable housing. So by training, I was an organizer and always working with families, especially in the inner cities where health issues and resilience really don't exist because people are living day to day, paycheck by paycheck. So how can they project for what is coming? And my work has been also about educating, and that goes with my staff. So for me, is how do we withstand another event, especially in our neighborhoods? How do we recover, and how do we build sustainable communities? And I'll just give you a brief example. In Bridgeport, when Hurricane Sandy came into play, there was a whole neighborhood, a whole project from public housing that was flooded, and people had to be relocated and move out of their homes. We have invested a lot of resources, but not just the state, the federal government, from raising the area to above the 100-year floodplain, from doing drainage, storm drainage, building a park so the water can flow, and rebuilding that community. So today, it took us many years, but we have built about 263 mixed income units. So the whole neighborhood now is different. The elevation have provided that resiliency for next event that we may have because they're by close to the water. So we know that we have to prepare our families because, when I say prepare, but we'll never be prepared for any events because it will come, as the governor was mentioning, the flood that we had, that people were not in the flood zone, so they didn't have insurance. So how do we make sure that our families understand, even when you are a rental person, you do need to have insurance, even for your personal belongings, because you just get, when we had that relocation of those families in Marina Village, in Bridgeport, they lost everything. And we had hundreds of families that had to be relocated. So we're trying to build with that in mind to make sure that we somehow prepared, somehow build resiliency in our communities, and also educating our families.
Joe, let me turn to you. Naveen's done an awful lot of work, with the department, with regulators on this. From the insurance capital side, we've got a whole bunch of people in the room from insurance companies with lots of money to spend. How do we get that money into the communities where it's needed most?
Yeah, I think that's been one of the issues that we've seen the last several years, really going back as far in time as you want with the insurance community, is if you look at it conservatively today, you could say the U.S. insurance balance sheet assets aggregate to somewhere north of $6 trillion. And it's easy to say, well, we should be using more of that for this positive benefit to society, positive benefit to the environment. The problem with that is the insurance sector is an unbelievably competitive sector. And so for us to be able to do that with balance sheet assets, we really first have to be able to achieve our primary goal of maximizing our capital adjusted, risk adjusted return with our balance sheets. We really can't compromise that as an entity. And I think what's happened in the industry is so often people come to insurance companies and they say, well, here, this is a good investment. Can we just have $1 million, or can we just have $10 million? But through that insurance lens, it really needs to make sense from a business standpoint. And then if we can get that secondary positive benefit to society and the environment, it kind of feels like, why would we not? But this, again, just my belief is that, as an industry, we haven't spent as much time trying to solve the problem through the insurance company's lens, which is how do you deliver that impact investment or that positive investment that does meet the capital adjusted, risk adjusted criteria. And we've been spending a lot of time thinking about that and doing that, of how can we use things like structured finance, how can we get something that is scalable, number one, so insurance companies can spend the time and actually allocate $20 million, $50 million, $100 million to that type of investment. And how do we make it capital efficient? And the goal there would be, how do you get it on Schedule D, which is where the lion's share of the assets sit. To do that, the investment needs to feel like a bond. It needs to pass the principal-based bond definition. And those are the types of things that I think the insurance community and hopefully the asset management community is starting to think more about, okay, how can we solve these problems through a lens that works for the insurance company? And if we can do that and then back into how do we get those assets to the local community and do that in partnership where they're needed the most, now we can really start to unlock that capital.
Let me come back to you, Commissioner. Joe just mentioned partnerships. What are examples of successful public-private or successful partnerships in financing resilience, whether residential or commercial, that you've seen? Just going to go with the Commissioner first.
So as the Governor mentioned, no one agency can help with these events that we have. There is a project in Norwalk. A whole neighborhood was also flooded with Hurricane Sandy. And it took about $120 million, a little more, but we had private investors, we have the federal government, we have the state programs like the low-income housing tax credits to build. Actually, there was about 6 feet higher, where now we have a little over 200 units of, again, mixed income, because we're trying to make sure that we don't concentrate poverty on one side. But that really changed a neighborhood. It transformed a place to make it more resilient. But it was the city of Norwalk, it was the state with resources, several agencies worked in that project. Took many years to get it back, but right now you drive by and the residents have a safe place to live. Now, the challenge that I find, and now I'm gonna, my colleagues on insurance, is that when we build housing, and I'm going to call it housing that provides affordable rents, because our housing, when you call about affordable housing, they're very well designed and built, because we have high standards, from energy efficient all the way to all different levels of net zero. But the insurance keeps going up, right? So in a way, one of the challenges that the affordable housing developers and nonprofits and for-profits are having is that every year it continue going up, and the rents that they're charging are not being enough. So in not only insurance, we have other like taxes, but insurance actually, they told me that it's going up about 20%. So there should be a way that we can look at all the elements that we're including in the building and the construction that is not like just the regular builders, that perhaps there should be some concession in working together to see, well, if we are building for resistance of wind because we have a hurricane, right? So we know that we are more protected, not 100%, but how can we get into that level of negotiation or partnership that we can talk a little more and see if we can come out with some solutions or some programs that is more beneficial to the type of work that we're providing.
Sounds like creating more resilient housing should mean that we're lowering the losses, so that should be reflected in your premiums. That's
yeah, insurance guy.
Let me turn to Dr. Kapnick now. Same question. Successful partnerships. What have you seen?
Yeah, I see an issue that was somewhat touched on there and with both of you, that there's misaligned durations with the incentives that require these cross-sector collaborations to be able to realign incentives. So an example of that I mean is if an insurer were to say, I will give you money or money up front to do resilience, but then they have a 2 to 3 year payback period where they need the policyholder to have that policy then at a reduced rate for 3 years to recoup their costs. Because they write annual policies, if a person does resilience, then they can go out to the competitive market and they can shop it, and they might be able to move to a different insurer. And so the insurer that actually incentivized up front that resiliency doesn't actually recoup the costs that they enabled through that incentive. And so I'm starting to see cross-sector and public-private analysis and projects trying to address these gaps. Like there's the program in Alabama for new roofs. There, the insurers all paid in, then they had the resilience spending that took place, and then as a pool, the pool was then more resilient, and then in that competitive pool, the insurers were able to recoup costs. But it requires thinking through how those cross-sector programs can work to make sure it realigns all the incentives, because once resilience is made, people then can go into competitive market to be able to find different insurance. And so if you don't find what those different types of structures are, we end up not aligning incentives, and they do them as one-off, and then you don't see those projects again. And there's many different examples where people have tried to align these incentives, and if you don't figure out how to do it right, they are just a single one-off consulting practice, and then it doesn't happen long-term.
Can I jump in on that incentive question? Because I think that's so the key to what we're talking about here. So like I mentioned before, I'm going to be talking to this group tonight about, they're all neighborhood people. There's the people who run the PTA or the YMCA or their teacher, or at this very small level, there's all these people who see the problem as we see it, right? And I think of it in terms of like in the concept in science about fractals, that things are that they behave identically at different scales, right? And so at the neighborhood level, you can think of it almost like an eddy in a stream, that the swirl that you'll see when you look down behaves very similarly to how a hurricane will gather strength in the ocean, and which will look exactly the same way that the Milky Way galaxy will rotate. And you're sort of at the galaxy level, right? And I was just at a conference for pension funds, for example, where the head of CalSTRS, one of the largest pension funds in the world, said, look, I have 2 goals. One is to make sure that when a California teacher retires, I have enough money to pay her and his retirement. And 2, that they live in neighborhoods that are opportunity rich, right? So how does that person, she has $400 billion that she has to invest. She can't write a check for less than $200 million for an investment, but how do you get it to the YMCA in a neighborhood? How do you align the incentive? So Joe talked about that bond, right? That's a tool that's at the kind of hurricane level, right? That allows the galaxy to talk to the stream, right? And so there are lots of things at the hurricane level that we're exploring. Like my friend Maggie Superchurch, who has the best name in the world, and I thought she was a hippie, but it's just Maggie Super married Bruce Church, so it's not that interesting. But Maggie Superchurch started this thing called the Healthy Neighborhood Equity Fund. And she said, I was motivated by one simple question. Why can I invest in a company that makes a pill that lowers blood pressure, but I can't invest in a neighborhood that does measurably exactly the same thing? So how do we come up with more of the thing, like we're all groupies of Brian Garcia, we think, the resilience improvement districts, I think that's at that's the hurricane level. Tax increment financing is something that's part of our world. That's at the hurricane level. There are lots of ways we could create funds, ready to learn at kindergarten bonds, resiliency bonds, to capture those incentives so that you could start aligning all of those different players' participation in a way that allows for those transactions to work more seamlessly.
By the way, just throwing a commercial here, it's Strength in Alabama, great program, has been copied all over. We've got some numbers from the last major storms. It really does work. And as I mentioned, we had a resiliency council. Our co-chairs will be speaking to the recommendations for Connecticut later, so please stay tuned. But in the meantime, let me move on to climate finance. And we've talked about partnerships, but who are the key actors right now? And how do they collaborate with local governments, with communities? And Joe, I'm going to start with you.
Yeah, I actually think there's a really good example right here from the state of Connecticut. One of the businesses that we have at Nuveen is called Nuveen Green Capital, is centered around loans called CPACE, which is Commercial Property Assessed Clean Energy. It was actually started back in 2012 right here at the Connecticut Green Bank. Jessica Bailey and Allie Cooley were working for the bank and said, surely there has to be a way for the commercial buildings in the US for us to be able to retrofit them to make them more environmentally friendly, or to incentivize new commercial buildings to build them from an above code standpoint, from both, again, a utility standpoint, but also from a resiliency standpoint. It's something that worked really well with Connecticut Green Bank, and in 2015 they were able to grow the business so far that then they were able to go into the private sector, set up an entity called Greenworks Lending, domiciled here in Connecticut. And then importantly, to get back to the stuff we were talking about before, in 2017 they were able to do the first securitization, which is, and it's great to lend money to people and do it at a small, to businesses or these commercial properties, and do it at a small scale. But to really make a difference, we have to find a way to aggregate these things into loans that can be unlocked, that now we can tap into institutional capital, tap into insurance capital. And the team's been able to do that over time. So in 2021, Nuveen acquired the business. It's now called Nuveen Green Capital, and I'm happy to say, kind of as of today, we have within the CPACE entity over $4 billion worth of assets under management, where we are doing these loans to commercial buildings to make them more environmentally friendly, and without going too far into it, are able to do it through that incentivization structure that allows them to pay back the loan over a period of time where they're realizing the cost savings of the investments, instead of needing to pay back the loan in 2 or 3 years, or pay back the loan or pay cash for the loan. We're giving them the proper incentive to be able to do it. And I think is a real success story of how a public-private partnership can ultimately evolve into something that unlocks more private capital at scale.
Now, David, let me turn to you. Joe just mentioned the asset management / insurance side. The people you regulate, the people the Fed regulates, banks. What is the role of the banks in low-income investment and resilience?
Well, I do think across the whole spectrum of investing, I think there are opportunities to invest in sort of climate resilience. So you can think about whether it's cash or cash equivalents, debt, fixed income, guarantees, in the capital appreciation category, public equity, private equity, venture capital, and then even real estate. There are ways in which you can sort of, and again, there's another article about this in the book that I mentioned. And I think the banks that you interact with are eager to participate and try to come up with these funds that make it easier to make those investments across the capital spectrum into communities that are sometimes hard to reach. And the nice thing about that is that they have a relationship with these organizations, with the community development financial institutions, with the sort of smaller entities that are able to deploy the capital at that scale. And so I really would encourage you to think about banks as a partner in this strategy to invest in those places to make them more resilient.
Dr. Kapnick, you're with JP Morgan Chase, not exactly a small bank. I tend to think investments like these is coming primarily from community-related banks. Am I wrong? What's the role of a bank like yours? What's in the sector in general?
Yeah, I think an important thing to remember too is there is access to capital for capital expenditures and upgrades for infrastructure, or for residents to unlock a HELOC and have funding to be able to make home improvements. However, in that availability of funding, that is for what people want to do on their housing or on their commercial real estate. However, it doesn't necessarily track to, are you doing it for resilience? Are you doing it for adaptation? And so there's currently disconnects where we don't know if that spending is happening on that because they've not been structured for that. But I also see this gap of potentially consumers not knowing what they need to do to be able to make those improvements, and then see those improvements flow through into what's happening in insurance. And so I think there's opportunity now on the education that actually has education that leads to action, that in accessing the funding that already exists, for people to actually then know what to do to actually improve their resilience. And I think this will increasingly be a trend as people see their insurance rates going up and are looking for ways to bring them down. They're going to try and understand how you'd make those connections. And I think banks have a role to play, and I think insurers have a role to play in that as well.
Commissioner.
In my world, well, HUD or the federal government was a big player. Not anymore, because many of the resources that we had lined up went away. But nevertheless, I think, so the state plays a role, the private sector plays a role. And as we saw in the previous flood issue that we had about almost a year ago, 2 years, Rob, about 2 years ago. So we had, the insurance company played the role because some families did have insurance. We also work with the banks. And the commissioner of banking was very instrumental to help people to waive payments on their mortgages while they went through the situation. The Small Business Administration with the ECD provided resources to make sure that people could, if they needed to rehab their homes right away, and the state played a role. So all together, we were able to address the issues. Now, the governor wanted to be proactive for the next event. So the way that governors work, the government and the bonding works for us is that we have a process, and it takes 3 to 6 months to get the resources, and we took that time. In the way to be proactive, the governor already approved, I have $10 million that is dedicated in hand in our account, that if any event related to housing, we're going to be able to act while we work with insurance company to come to the table, while we work with the financial institution to come to the table, and the residents. So that's the way, and we're not putting any plans together because we don't know what that is going to look like. But we could proactively work with the residents right away.
Dr. Kapnick, I'm going to come back to you again. Only because you're the bank that holds my mortgage. So, Neil deGrasse Tyson, great astrophysicist, he once said, "You may not believe in climate change, but your insurance company sure does." Okay? That's a reflection of risk. And part of what we do with investments is we balance risk and return. So I've got a couple of questions on that. One is, what are the most effective tools and models that you see out there for funding climate adaptation? And I think foundational to that is, how do you price risk? How are the markets pricing the risk? What barriers exist?
Yeah, so I was at the forefront of this R&D for a while with the government and public and partnership with the insurance industry. We have all this science over here, and we have the risk modeling that's over here, and it's really only the last few years that climate change and a lot of the climate information is flowing into like the projection of the future instead of just what is the risk today. And I think that is going to continue to accelerate, where more and more of that information is coming in. Looking at all of the risk modeling firms, they're all bringing in climate expertise right now. There are tons of startups in the space. As you mentioned in your remarks, First Street, which has really only been in the last few years, and was a bunch of ex-NOAA scientists that went and built out that information because they saw a gap in the market that was needed. So the models that are out there, there are some nonprofit data sets. There was government data, but there's less federal government data now. Several states are stepping up with their own data sets that are hyper-local for their states so that the states can manage what the risks are. That's starting to go into catastrophe modeling. It's starting to go into risk analysis that goes into real estate information so that the consumer can use that. It's starting to be in the markets in terms of pricing, but it isn't necessarily in the markets. There's only a couple of cases now where actually credit rating agencies use resilient spending to actually upgrade or downgrade companies. So it's not widely across the entire sector. So you don't necessarily get a benefit of spending on resilience if you're a corporate right now. So we're in the early innings, I would say, of that actually flowing into the financial models, that then you actually get the benefit of the resilience funding. Now on how do we incentivize the resilience funding, as discussed on the bond market, there are ways to link bonds to certain outcomes, but that is still a smaller part of the market. There also are the beginnings of, I've seen some muni bond funds that are trying to build resilience, and it has it in it as a general funding mechanism. But I think we're going to see more of it. The munis market does not show differences in actually the pricing between municipal locations that have very different physical risks that could affect their ability to pay back into the future. As more of that knowledge goes into the pricing models, into credit risk, I think we'll start to see some differences, and we'll start to see desires to fund more on resilience to be able to get out of that, where they start getting pricing differentials due to their perceived risks and lack of adaptation funding.
Not to put you on the spot, but I will. Is this a market intelligence failure, or is it simply that we haven't, that by we, I mean lenders, have not kept up or caught up with the current state of science?
I think that the state of science has evolved, and it's now being translated in, and I think we could have a rapid shift over the next few years as that comes in and starts getting priced into the market. And I speak about this a lot, that those investors that are starting to account for it already, they're seeing opportunities because they think things are mispriced in the market right now because of that. And more groups are going to be bringing climate risk in and are going to be analyzing that. And so as that happens, there might be shifts in capital availability.
David, what do you think from your perch and the Fed? You get a wide range of banks that you look at.
Yeah, and we definitely have a group that does a lot of analysis on the risk that's involved to banks, to the financial system. One thing I would just sort of maybe switch directions slightly, though, just to mention that after the fact, there's quite a bit that banks can do, and a lot that community development can do in order to sort of recover after a disaster. So banks, I mentioned before, the Community Reinvestment Act of 1977. It was updated in 1995. There was an effort to update it recently, and that was challenged by the banking sector, so that got tabled. But there is still sort of the legacy rule from 1995 that's in effect, and one of the things, banks are asked to sort of make loans back into the places where they take deposits. And of course, since it was written in 1977, it's where they have bank branches. So there's what they call their assessment areas, is where they can make those loans and get credit for it. But for disaster recovery, they can make a loan anywhere in the country. So that's something where, again, they're very much looking for places where they can put those CRA dollars. And so that's something you could be thinking about in terms of a partner for disaster recovery would be the banking sector to get CRA credit. And then there are other tools as well. There's the Community Development Block Grant Disaster Recovery Program. One of the problems with that program, and that's been, I think, $100 billion has been lent out or granted out through that program. I think it's a really effective disaster recovery program, except for the fact that it's slow. So there have been some really interesting innovations lately about bridge loans that are able to sort of Enterprise Community Partners is one of the nonprofit banks that's really on the forefront of that, where they're coming up with new tools where they can upfront the money so you can get the people back into their homes, you can get those communities rebuilt more quickly, more defensively, and then the money gets paid back over time. And so I do think there are lots of ways you can be thinking about the community development sector as your partner as you try to recover from disaster and then make those places more hardened to future calamity.
Commissioner, you'd be on the flip side of that. If something happened, you would be the one reaching out to the banks and to the financial institutions. What have you seen, and has it worked, in your opinion?
I think that when we have a disaster or an event, we all come together, actually. People do want to work, financial institutions do want to work with residents, is how do we bring together providing the information that they need. And it's not only about money. I mentioned before about the banks and the homeowners. It's about, hey, can you waive 3 months or hold those payments for 3 months because people need to be on their feet again. So that type of arrangements where we sit down and talk, it does happen. The federal government, as I mentioned before, has been one of our partners, and I hope that we continue to be doing that because otherwise we don't have enough resources. And our investors. But I have to confess one thing. I hated insurance.
This is the wrong place to say.
When I was a developer, I hated it, right? So I had to hire a consultant because I was also doing deals on tax credits. And you know, investors want to be protected 150%. So because I didn't want to be upset, I just hired consultants and said, just keep me safe and my residents. And I did that, and the first person that I met when I became a commissioner, guess who was that person? The insurance commissioner. We both were hired the same day. So that's something that I needed to be more friendly with insurance. But nevertheless, we have been working also in talking about how can we, the insurance industry, the developers that we bring in, get together and see how can we benefit each other from the programs, but also from the things that we are doing and the insurance company can learn so that we can talk about in affordability when we're trying to put so much resources into affordable housing. And then you have the loans, and then you have the taxes, then you have the insurance. It really is not affordable anymore. For the developers that have to make those units affordable because they're restricted, it's more difficult to be able to meet that operating and the benefits that they give to the residents. So I'm hopeful, and I always have faith that people come together when we have an event and that we are creative and get things done. So always look at the heart of the people, bankers. I know they have a heart.
Joe, I'm going to ask you, and it's a pretty basic question. It's one that builds on what the Commissioner just said. But what role can the insurance sector, the people you see sitting here today, play in accelerating the investments? How can insurance incorporate resilience to reduce costs?
I think one of the best things that the insurance industry brings from an investment standpoint that's not talked about enough is just that it can be unbelievably patient capital. And these are areas that really require that patient capital for the innovation, for the development, for some of these kind of more early stage things that are happening. However, that creates a challenge because the issue with that is how do you get patient capital through that capital efficient, risk adjusted lens that works from them. And I think that's one of the things we're most excited about from kind of an investment landscape today as we sit here in 2025, as you've probably heard the word complexity thrown around from time to time. And I think sometimes complexity can be potentially a negative thing for investments. Sometimes complexity can be a potentially positive thing for investment. And one of the areas where we're spending time is thinking about how can you use the complexity lever to basically dissect investments into certain categories that make sense and work for an insurance company, and then certain categories that make sense for some other type of investor. Neither one of those need to be bad investments. It just needs to be identifying the parts of the risk that the entity wants and create an opportunity for insurance companies to provide the patient capital that ultimately gets to these areas at scale in partnership with another investor. And in the past, that would have been done really almost exclusively through public-private partnerships. What we're starting to see more now and what we're excited about is really kind of the growth and the interest of what we would call catalytic capital. And think family offices, endowments, foundations. And this is not philanthropic capital, so there is a financial return that they want to generate. But in addition to that, they really want to maximize the positive benefit to society and environment that their investment dollars can have. And so what we're starting to work on now, and it's in its early days, and again, it's the complexity factor is definitely there. But how can we pair catalytic capital with insurance capital to really start to unlock the insurance piece at scale and do so with a partner that many years ago you wouldn't have thought, okay, well, these are natural partners. But when it comes to that positive benefit to society, the positive benefit to environment, they're really naturally very aligned. And through education and complexity, we think there's a real opportunity for the insurance industry to do a lot more in the future with their balance sheet assets.
Dr. Cannon?
And to my previous point, it's because they're so long duration, they can wait 10 to 20 to 30 years, that you can actually make very different choices about what you're doing. I also wanted to add to the other point, a trend that I'm seeing is that insurers are putting out more and more information based on what the risks are from their own risk models. There's becoming more transparency and availability of that data. And it's been incredibly powerful in making people realize that they have resilience that they should be doing by accessing that data from the insurers themselves and their pricing model that previously was not necessarily available years before. And I think that's pushing people to realize it's creating information, education, but also transparency and figuring out what does one need to do to invest in resilience to be able to get benefits potentially in the pricing mechanism back from the insurers. And I'm seeing this trend starting at the reinsurers, but it's also starting to happen in the broader insurers that are able to pool all the information to actually pinpoint what the extreme weather and climate risks are.
Can I jump on that just for a second?
I was just going to tell you, I don't want you to miss your flight, so.
Yeah, no, I know, I'm gonna have to sneak off. But this idea of like this catalytic capital, I mean, you might think of that as just a bunch of do-gooders, but the Global Impact Investing Network has an assessment. They think it's about $1.5 trillion assets under management in that category. So it's not small. And the other thing that hasn't come up as much, but I think something to consider are, like sometimes I dream of being wealthy, and the business I would start would be to start a reinsurance company, because you got me thinking about that, Sarah, about how I would buy the downstream catastrophic risk of a location, and then I would just manage the hell out of the upstream, and in that regard, I think you should really be thinking about who owns the downstream medical care cost risk for the area you're concerned about. Because there's a big payer there who might be in the position to be a co-investor to try to make those communities more resilient and healthier, which will save them money. And I think about places like, if you have an integrated system like a Kaiser Permanente in Hawaii, for example, like they pretty much own the downstream medical care cost risk for the island of Maui, for example. And that's an instance where when they realized that, they started investing in preschools and thinking about flooding and thinking about these other issues that may not, so you may not be thinking about a health payer as a partner, but I think they're really a powerful player in this conversation.
Well, thank you all. First, I want to thank somebody who's not on the stage, Francis Bouchard, who was originally scheduled to be the moderator here. Unfortunately, Francis has COVID, but the good thing, great person, he wanted me to make sure I shared that with you, reminded you the vaccines are here. Go get vaccinated, please. And that said, thank you all for being here. The panelists have been great. Please give them a round of applause.
Good to meet you, David.
Oh,
Thank you very much to our panelists for a very lively and fun conversation, for the most part. At this time, I'd like to welcome to the stage the Deputy General Counsel for Nassau Financial Group. Please welcome Sam Caligiuri.
Thank you, Connor. Thank you. Commissioner Mais, Deputy Commissioner Koski, good morning. My name is Sam Caligiuri, and I'm very proud this morning to represent Nassau Financial Group, the community impact sponsor for this important conference. Nassau is very proud to be a Connecticut-based insurer, one of the top writers of fixed annuities in the United States, and to be able to call Hartford and the iconic boat building our home. We are also proud to be a strong supporter of the Metro Hartford Alliance and its CTIFS initiative, which is a co-sponsor of today's conference, along with the Connecticut Insurance Department. On that note, Commissioner Mais, thank you, sir, for your leadership on the critical issue of climate change, not to mention impact investing, on which I know you've spent years of tireless effort. It's really a credit to you, sir, that you can draw such a large and esteemed audience to this conference today. I see, for example, South Carolina Director Michael Wise, who is just sitting there, and I know Superintendent Beth Dwyer is going to be here if she's not here already. These highly esteemed regulators would not be here if it weren't for your leadership, Commissioner, and I want to thank you for that, and I know the entire crowd feels the same way. Reflecting on this conference, the word impact kept coming to my mind. We are all here today in one way or another because we are committed to having an impact on the world around us. On a day-to-day basis, Nassau works to impact people's lives by helping to provide for their retirement needs. But with respect to climate, we also believe that we can help the broader cause of protecting our climate through the investment decisions that we make, for example, and specifically today through our partnership with the American Red Cross. Nassau has paid for the supplies needed to create 500 humanitarian comfort kits, which the Red Cross distributes at disasters, including natural disasters, which, as we all know all too well, are often caused by changes in our climate. Last night, those of you who attended the reception helped us to make 250 of those kits, but we have 250 more to make, and so I'm here to make a plea to you today. During a break at some point today, certainly not during any of the sessions, please take a few minutes to go outside. You'll see the Nassau table and the American Red Cross table out towards the back of the area outside of the conference room, and help us to make a few kits. It will literally take you 5 minutes to make 5 kits and help us get to our goal of being able to present the Red Cross with 500 of these humanitarian crisis kits. By joining us in this effort today, together, we can help a family struggling to make their way through the initial stages of a crisis, either by virtue of natural disaster or a house fire, get through that very challenging time. we will probably never meet those people, but we can leave here today knowing that we did a little something to impact them in a positive way. Thank you for being here today, and enjoy the conference.
Sam, thank you so much. And again, I encourage you to participate in those kits, and let's get that goal accomplished today. Following our keynote conversation, our first panel discussion is going to focus now on managing the economic and social risks of climate change and help us understand the financial and equity challenges of climate risk. Moderating this conversation is the Executive Director of the Institute's Griffith Insurance Education Foundation. Please welcome Frank Tomasello and our panelists for today's conversation. Thank you.
Thanks.
All the way down.
Well, thank you, Conor, for the introduction, and also our thanks to Susan Winkler of CTIFS, to Commissioner Mais of the Connecticut Department of Insurance and their respective teams for inviting us to take part in these important conversations today. The urgency around climate risk and insurance market stability is accelerating. Some would describe this as a period of unprecedented stress. Challenges related to availability, related to affordability abound. But with those challenges come opportunities. And in the 60 minutes ahead here, in the insurance capital of the universe, to quote a certain individual present in the audience, we will explore opportunities to address those challenges. Joining me in discussion are distinguished thought leaders from across the insurance ecosystem. Please, let's welcome Eric Nelson to my immediate left, to your right, the Senior Vice President of Enterprise Catastrophe Risk Management at Travelers. Ms. Amy Bach, Executive Director, co-founder of United Policyholders. Also with us on the panel today, Mr. Roy Wright, President and CEO of Insurance Institute for Building and Home Safety. With us today as well, former Executive Deputy Superintendent for Insurance at the New York State Department of Financial Services, Varadhan Agnihotri. Thank you for being with us. And last but not least, Mr. Brian Garcia, President and CEO of Connecticut Green Bank. Thank you so much, panelists. Look forward to the conversation. To get things started, I would appreciate a bit of a level set, perhaps, for some members in our audience, and ask if we could take a step back and obtain your thoughts on today's climate risk landscape. Are the climate risk threats of today unprecedented? Can you help sort of set the table for us? And perhaps, Roy, if I may call upon you to kick us off, that'd be great.
You look across the set of perils that hit us in the Nat Cat kind of space, and clear correlation on the flooding, the Atlantic hurricane risk, wildfire side of the equation, and those elements that are in play. I do think that we have seen this evolution in that space where we have consumers who otherwise didn't have to think about this, having Mother Nature come through their front door. And when that happens, driven by severity and frequency elements, it causes a reckoning. And I want to make sure that we're clear that as we look at these elements, climate attribution clearly has a connection on that flooding, on the hurricane, on the wildfire side of the equation. It's not as clear of a connection when we deal with severe convective storms. Somewhat related, but a couple paces of removal in that. Yet that part of the country is experiencing what they perceive as the same phenomena, which is, but I've got events and I've got expenses that are here. And so I think there's two things that are happening at the same time in the country. Different geographies experience it in different ways. Some of that is climate driven, and some of it is we've built more structures in harm's way. Those two pieces are coming together. I think for consumers, they rarely untangle the two.
I think amongst the experts, we can nuance those pieces. There frankly are different strategies based on those two pieces, but I think both of those are in play as we have conversations about the climate drivers.
Thank you, Roy. Anyone care to add any color there?
I was just going to add a little bit more detail there as the insurance guy on the panel. So if you think about climate risk in the insurance industry, we call it catastrophe risk. And you look at catastrophe risk losses that have occurred over the last decade, over this decade that we're expecting right now, it's going to amount to about $1 trillion in catastrophe losses. That's a big number. That has doubled in the last 20 years. Doubled. So you think, what's driving that? And I want to just put this in perspective. Inflation, inflation, inflation is the number one issue. And I'm not talking about anything with tariffs and everything else that might happen right now. It's over the last 3 or 4 years where building and labor materials have gone up significantly. When you think about insurance claims, it's mostly about the roof. And so inflation is run for building materials about 10% that we've seen loss trend, we call it. In addition to that, Roy mentioned where you build. Where you build is so critical. Connecticut, we're not building a lot of new houses, a lot of new neighborhoods, but when you go down south in Florida, think about where you build and where you build close to the coast. Well, that might have accounted for, say, 3 to 5% annual increase because we're building in harm's way. And then climate, Roy talked about climate already, but I'm just going to give you numbers to give you a perspective. Karen Clark and Company is an expert modeling firm. They have a paper out on climate change. And they've put the scenarios at probably about a 1 to 3% annual increase in losses due to changing climate conditions. As Roy said, worse for wildfire, a lot worse for wildfire, for flood. There's indications for hurricane. Less so, the science is out on SES, tornado, hail, and some of the other perils. So that just shows you, but I want to add one more comment. Where you build is so critical. We did some analysis looking at the hills in California, and you think about low risk versus high risk in California, that's 10x the risk. So if you're paying $1,000 for insurance in a low risk area, and you build in those hills in a high risk area, you're facing a $10,000 premium. It's 10x the risk. So where we build is critical part of this dialogue.
So my organization has been working to help the consumer adapt to the way the insurance industry is adapting to the new normal. We heard a lot of interesting comments in the first panel, including Commissioner Mais saying, well, you may not believe in climate change, but your insurance company sure does. That's a really profound recognition of what is so unprecedented about what's happening is that for consumers, they are starting to be forced to think about insurance a lot more than they had been, to pay more, but also to think about the fact that they have risks and that they can't, it's not just some automatic thing where you give the insurance company money and all your risk is gone. It's not like that. It maybe never was, but it's not like that at all now. So while things are unprecedented, and I think consumers are behind in terms of really grasping what's happening, one of the phenomena that is unprecedented is the impact on the reduced competition, reduced appetite for insurers to compete in certain areas, and then this explosion in technology, including the predictive modeling that Karen Clark and her colleagues are doing, the aerial images that insurers are now using in place of traditional underwriting approaches, and basically what I often call the TMI that insurers have about risk that is really causing some seismic shifts in what they're charging, and then of course this growing swath of Americans that don't have a mortgage and are opting to go bare because they just can't, either they can't stomach the premium or they just think it's not worth it.
Thank you, Amy. Bhavna, Brian, anything to add there?
I would just talk a little bit about the ripple effects, right? So we're seeing these increase frequency and severity of events, right? And they cause ripple effects. Yes, they cause these insurance costs, but then they also cause increased first responder costs, right? There's the debris removal and the cost to local governments to doing all of that. There's the supply chain costs. For example, in Mississippi, when there was flooding, $1 million of grain was just sitting there, right? So that disrupts the entire market for the grain. And also we're seeing insurance deserts, right? So in California and the wildfire areas, in Louisiana and Texas, in coastal areas in Florida, there are many areas where we're seeing insurance deserts. And when you see that, an insurance desert is when there's no insurance available, right? So then people go into the risk pools, and the cost is not just the risk pool is picking it up and providing less coverage for the consumer, but it's also the ripple effect on the property value, right? If you're not able to buy insurance, your mortgage is not going to be approved. So therefore, there's less demand, and it has this rippling effect. So we need to look at the, to the gentleman from the Fed's point earlier, let's look at it a little bit wider and think about the ripple effects.
I guess what I would add is I'm not sure what the legal or scientific definition is of existential threat, but I think the governor and the commissioners alluded to it earlier in the severe storm we experienced here in Connecticut and Naugatuck Valley. I mean, when you have 14 inches of rain coming down in a number of hours that was unpredicted, that is a 1 in 1,000 year thing, 1/10%. I feel like that's biblical. I don't know how the insurance industry thinks about those sorts of dates, but the existential threats are there, and they're coming in a variety of different ways, whether we can predict them or not. The conditions are going to come together, and we're going to experience more and more of these sorts of events.
Thank you, panelists. Appreciate your thoughts on the threat landscape today. And you spoke a little bit to this, but to drill down perhaps maybe a bit more deeply, how would you describe or how do you view the current state of domestic insurance markets in the U.S.? Obviously, we sort of talked to that a little bit, but care to share any thoughts there? Amy?
Sure, I'll start. Certainly, all eyes have been on Florida for many, many years. A lot of people peg some of the problems in the Florida market, property and casualty market, to Hurricane Andrew back in '92, where that was kind of a wake-up call, I think, for insurers in terms of the dollars that were involved. And since then, it's been a succession, and you can see a lot of the experiments that Florida has been doing in this sort of interface between government and private sector. You see the public hurricane model in Florida, which now California is going to be emulating. You see the Florida Hurricane Cap Fund, reinsurance facility that there's a lot of discussion in other states on can we do that. And so, I remember in the early years, United Policyholders is based in California. In the early years, I'd say like 2016, when we started seeing the non-renewals coming faster and not seeing competition filling in, where one carrier non-renewed, we were not seeing as much enthusiasm among their competing companies to fill in, and that's when we started to see the FAIR Plan growing. So I think, and originally I remember our commissioner saying, Amy, please don't use the word crisis because we don't want to stir a panic. And I do think that there is a lot of panic. I think there's a lot of media coverage of what's happening with insurance. And there's a lot of journalists who are just dipping their toes in the insurance waters and making some pretty scary, predictions. But I do think that, in a lot of the states, from what I hear from regulators, that things they're not as dire in a lot of states, but that we do have some exemplar states where, we have some insurance deserts. And that's primarily in Florida, right? High property values, high density state, similar situation in California. But there's lots of areas, including Long Island, in New York, where there aren't a whole lot of options. There's 1 or 2 options. So yeah, things are dramatically different, but maybe a little more manageable than you might think from reading the headlines.
Thank you, Amy. Panelists, any other thoughts there? Anything to add?
Yeah, I would just add a couple other, I think you said it well earlier. The question is, I don't like the word insurance desert because I think you can find coverage. The question is, at what price? My parents have a place down in Fort Lauderdale, and you'd think right on close to a mile to the beach, I'd have a problem. I found coverage. I did not like the price, but I found the coverage. And so that's, you know, there is a cost to living close to the beach, I try and explain to my parents. And so I think we do have to step back. We have a day of reckoning coming in certain ways. Think about the NFIP program. NFIP program by the federal government, in my opinion, rates are at least subsidized by 50%, right? And we already think that the flood rates are expensive, but if that were in the private market, it would be much different. What's happened with those subsidized rates? Insurance is supposed to be a risk signal, right? That's the core tenet of insurance. We spread risk over people and over time, and it should be a risk signal. By subsidizing the rates, well, we've sent a signal to those consumers, right? It's terrible now, right? Now they're faced with these, even this risk rating 2.0, where they're starting to get the rates more towards actuarial sound, and they're facing sticker shock. And so we have to think about, as we suppress rates in some states, how does that create an availability crisis? And is there better ways to think about affordability? When I worked with Wharton School of Business years ago, they said, boy, we want the right risk signals, but we have to recognize there's an affordability gap. Should there be a mechanism outside of insurance premium, an insurance voucher, or some other mechanism to help those in need? And that's what we have to think about. We have to think about the unintended consequences of allowing unfettered growth with the wrong risk signals.
Yeah, I think one other dimension, inside a room like this, the terms availability and affordability come with full understanding and meaning. I think for consumers, those sound like code words that they don't quite get. What they experience is they don't have a choice in terms of who their insurer is going to be. They don't feel like they can go out and just get who they want. And I think in that case, again, a term we know in this room, but the E&S market is becoming more mainstream. Not something that would have been discussed 10 years ago. And so that point that goes, there's a price, whether or not that is affordable, whether or not they want to pay it, but it's become a place where a really complex set of industry dynamics that have long lived in conference rooms like this are now setting in communities. And particularly for the 5 or 6 states where the availability piece is now front and center, they're learning all these new terms, and maybe they should be headed towards the E&S market, but they don't understand what it is. It doesn't come with the same kind of protections and the like that are in place. They don't even understand why there is a difference. Yeah. And I think whether it's work that policyholders or others are doing in that space, consumers, I think, are really left confused about what to do. We'll turn to the resilience side of the equation, but I really got to double down on understanding that insurance context, because we'll say, hey, there's a way to reduce your risk, and that will meet the product that you're buying, yet they're still struggling with the fundamentals of the morass that has become the product that they're trying to understand. We says, oh, put a better roof on, oh, do defensible space, do this, and they're like, yeah, but what does that do to my product, to my price? I don't understand.
Thank you, Roy. Consumer education is a topic I would like to explore here in the minutes ahead. But before we do that, on the topic of availability and affordability that Eric sort of cracked open for us, I'm curious, what can we learn from both present and past efforts that are underway in the various states to address those challenges? History, I think, can be a valuable teacher. Varadhan, do you care to maybe share some insight there?
Sure. So I want to talk about 3 different states that we've seen address these issues. One, Alabama, which I think one of the panels earlier talked about, the Strengthening Homes in Alabama Act. That's a grant mechanism that gives grants to people in Alabama to fortify their homes to the IBHS standards. And it's really, the DOI, as Commissioner Mais referred to earlier, has just taken out a report, and it's shown to be extremely effective. So the homes in Alabama that were fortified post-Hurricane Sally performed 50% better than homes in a similar code. So what does that mean in terms of dollars and cents? So Alabama, in the entire time that this program has been in existence, has put in $86 million into the program, right? So $86 million is your cost benefit, is your cost. What's the benefit? How many of you think, we're gonna do an audience poll quickly. How many of you think we got the $86 million back?
Yeah.
One, really, guys? All right. How many of you think we 1.5 times that? Okay, a couple more. No audience participation here. The reality is we almost doubled it, right? So insurers saved 75% of the losses they would have spent. So they saved 75% or $112 million. That's a lot of money, a lot more than the 86. And then policyholders, by not having to pay deductibles because their homes were fortified, they did not incur losses, and that saved another $35 million. So that we're almost at 150 there, right? So almost double. That's a lot of money. And to my earlier point, think about the ripple effects, right? So debris didn't have to be removed. First responders didn't have to come in. People can go to school. People can stay in their homes. People can go to work. Businesses are open, and the GDP ripple effects are significant. The Chamber of Commerce recently, I just want to highlight the ripple effects and quantify them. The Chamber of Commerce recently issued a report, and they said $1 of mitigation, just $1, gives you $13 in savings of losses, right? So insurance companies pay $13 less losses. And then on a broader GDP level, right, economic value, you're saving $33 worth of economic value. And that's, again, people staying in their homes, people being able to stay in their businesses, businesses remaining to be open, all of that ripple effect, the healthcare costs. So $1, 13, and then 33. That's called return on investment, right? And we're seeing states, other states like New York, like Connecticut, California, North Carolina, doing different things in terms of mitigation and having different programs such as this to encourage and provide grants to their homeowners. I just wanted to highlight Alabama because of the recent reports showing the clear cost benefit. Second thing I wanted to talk about is North Carolina. So I think one of the earlier panels was talking about these resilient bonds and resilient financing. North Carolina is an excellent example of this. They recently issued a catastrophe bond. And let me take a step back and talk about what a catastrophe bond is. Catastrophe bond is, it's a capital markets instrument where investors can buy a bond, right? And if it has really high, low risk of being triggered, right? So for like maybe a 1 to 3% risk of actually losing your money on the bond. And it basically pays out when there's a high number of losses. So let's say there's this huge Hurricane Sandy, Superstorm Sandy type event. If that happens in the next year, then investors lose their money, right? So this is a normal thing. The insurance markets have been doing this for some time. The interesting thing about the North Carolina bond is it added a 35 basis point spread called a resilience interest spread. And that is such a beautiful creative financing mechanism because if losses are below the threshold for that interest spread, which is below the loss trigger, North Carolina gets the money, right? And North Carolina's Insurance Underwriting Association uses that money to fund the fortified homes, right? So it builds it in. It's great for investors because they're presumably going to buy the bond in future years. They're also immediately getting that extra 35 basis points because if that loss level is triggered, so even if it's between, that one is at a 60% threshold. So if it's between 60 and 100% of losses that would trigger the bond, the investors get that 35 basis points. So even if they don't lose the money on the bond, they have the potential of getting that upside. So, and plus it has all the features and the benefits of having a resilient bond, right? So they get all kinds of credits in terms of their investments logic, right? So that's the second one. Love it. Third one is nature-based solutions. And nature-based solutions are just that, solutions that are based in nature. So improving the viability of coral reefs, improving mangroves, and these nature-based solutions have significant benefits in terms of mitigation. In fact, they're seen to be even more effective than fortifying homes with the roofs and things like that, because your dollar just goes a lot further. And we're seeing communities do this. So there was, Mexico started it with the coral reefs, and the Mexico Coastal Management Trust issued a catastrophe bond where Mexico essentially would get paid out if their wind speed hit a certain trigger, right? So there are certain parametric solutions where instead of having to prove your losses, it's triggered on a certain level of, definable, easily definable trigger, like wind speed or earthquake level on the Richter scale, et cetera. So Mexico said, Mexico got the benefit of this, and they were able to put money into their coral reefs. Now you think coral reefs, they're great for diving, great, maybe some fishes are saved. You think of it as some, tourism industry would be saved. You don't realize the level of it, level of mitigation that happens. In fact, coral reefs can absorb up to 97% of wave energy. So think about that when your tsunami is about to hit you, right? Mm-hmm. Think about that when there's just general storm surge, right? That's a lot of savings. And these nature-based solutions can really provide that. And we're seeing it in terms of the US, we're seeing Hawaii implement this. And since 2022, the Nature Conservancy has been buying these bonds for Hawaii, and they expanded it even further in 2024. So these are just 3 examples.
Bhavna, thank you. All very positive examples, which is encouraging. Anyone care to sort of add any gloss on what she shared?
Sure.
Amy?
Sure. So we have some great progress, as you just heard some of those examples in South Carolina, Alabama, and Louisiana, trying to figure out how much money can be allocated from the state towards the cost of helping households and communities and businesses implement risk reduction, improve property improvements. But I think where we are really, and for hurricane, there's some really fairly cost-effective, straightforward methods, right? Strapping and all that. The more challenging flood, obviously elevating homes, very expensive. So that remains a challenge, as well as the aesthetics for people. In California, there are many stakeholders that are hard at work trying to take lessons from other states and as quickly as we can spread the information. IBHS's Wildfire Prepared Home base and plus the issuance of those standards has been a big leap forward, as have the sort of the companion standards that the Department of Insurance put out to tell people, okay, these are the things that you can do. Where we really have a challenge now, and I think there's just a lot of dynamic struggle, is aligning the incentives for the consumer so that there's an assurance, if I do spend this money and I do uglify my property, I'm going to get rewarded. I'm going to get rewarded. And that's the rub, because I think insurers are still very much looking for a lot more evidence of the efficacy, for example, of wildfire risk reduction. And there is a lot of kind of political tug of war of, elected officials wanting to mandate discounts, but insurers saying, don't mandate until there's scientific proof of the reduction value. And then you have something that my friend Roy and I spent some time discussing earlier, which is people's real kind of deep attachment to what they have and what is, and a feeling that if you're going to make me do these things, it better dang well be worth it for me, and I better not lose my insurance after I've taken down my favorite tree and killed my grandmother's rose bushes. And that's really, I think...
Transplant
yeah.
rose.
Okay. So I think that's, I would say, one of our biggest challenges, in addition to, if you go to the NEIC meetings, you'll know at the last NEIC meeting, a group of my consumer advocate colleagues and I did a presentation. Don't tell me to read my policy because it's kind of empty, since a lot of people really do have a hard time understanding where their holes are going to be, where their gaps are going to be, and what they can rely on, and that causes a lot of frustration and anger.
Yeah, I think that, let's take both of those perils. Let's take the harder one and then the one that I think has a clearer path already. On the wildfire space, it is both what you do at your parcel and your neighborhood. Unlike any of the other catastrophe-driven perils, it is about collective action, not just individuals. Yes, we need to incentivize people to start to be the leader in their community, and then your adjacent properties matter. This is not true in wind. This is not true in flood. You can have done the right thing and you're fine. In wildfire, it is that collective piece. And as we look at these elements, the willingness of people to take those actions. And in the California market, they do get price considerations when they do that. But if you get $300 a year, but you spent $4,000 taking the action, you start, well, the premiums didn't pay me back. No one actually told you that it was going to pay you back. But there are some consumer pieces. What is farther along and more mature is on the roof side with Fortified. And wonderful job laying out that piece from Alabama. It is interesting to me. We were out in California, and Commissioner Fowler from Alabama had flown out at the invitation of Commissioner Lara in California. This interesting bromance between two guys who stereotypically fit in their context, but don't really belong together very much. And when Commissioner Lara introduced Commissioner Fowler at a state Senate meeting, hearing, he goes, there's not a whole lot that we say we should do like Alabama, but they're doing this right. But the Alabama context has some layers to it, because as much progress has been made, the grants are important. The grants are only responsible for 17% of the designations in the state. The market has made that standard normal. And I do think this is a place where bridging, where capital comes in, how we can actually meet people in this element. I'm a fan of these grant programs, and they don't win on their own. Right. It's that point by which the building code reinforces it. The builders and roofers change what they are normally selling in such a way that it becomes the default. And that's when we really do see the rising tide help that play collectively and save tens and hundreds of millions of dollars, so that insurers are like, I'll take more of that. But I do think as other states come along in this space, sometimes they focus just on the grant program, or they focus just on the discount piece. I tell them, I'm like, those are true, and the building and contractors came along, and they changed the default code. All four of those are true, and collectively, that has produced. We will get there on wildfire. We are not there today. Yeah. We are very early in this pathway on the wildfire side of the equation. It brings other complexities. And even when folks are told you may lose your insurance if you don't change the landscaping outside of your front window, they'll tell you, let's see. And they'll gamble with it. And then when they get sent to the FAIR plan, the insurer of last resort, the residual market, they beg to come back. Because at that point, they're like, I don't want, that's not great coverage, is it?
Thank you, Roy. I'd like to drill down a little bit on opportunities for economic incentives to drive mitigation. And I think on the other side of that coin, perhaps this notion of maybe mitigation creating economic value as well. And I think Roy was getting to a bit of that in his comments. Brian, would you like to kind of jump into the fray there? And
Yeah. I feel like Roy was talking about in the public policy parlance, market transformation, right? We really want to get to the private sector investing because that's where we get to scale. So I wanted to talk a little bit about how events, climate-related events, lead to a public policy response, how a public policy response can lead to private capital mobilization to help us get to community resilience that we're after. So I want to give a few instances here in Connecticut as to how that has played out over time. In August of 2020, many of you here who reside in Connecticut experienced Tropical Storm Isaias. Many of you may recall that some over 700,000 residents here in the state lost power, not for a couple of hours, not for a couple of days, but for a week, maybe more. I'm a former Peace Corps volunteer who served in the Republic of Kazakhstan. I could tell you a day or two without power was pretty difficult because you not only didn't have power, you didn't have heat during the middle of winter. That was a super difficult time. But this is the sort of stuff that just shouldn't happen in our country, right? So it was a difficult time. The legislature came back into special session that fall because of this instance and passed a really foundational public policy, Public Act 20-05, colloquially known as the Take Back Our Grid Act. It had a lot of really fundamental resilience public policy aspects to it. Several of them are definitional. One is around resilience. What is it? Preparing for, responding to, recovering from, human-induced, climate-induced, all these different sorts of impacts. So it defined resilience over a period of time. It also importantly defined, as the Federal Reserve Bank David was talking about earlier, a really important definition on vulnerable communities and expressed a priority, as we heard the commissioners talk about, in terms of ensuring that vulnerable communities are taken care of, and included CRA-eligible communities, the Community Reinvestment Act eligible communities, which really refers to less than 80% area median income census tracts in our state. So those two definitions came out of that act. Then the legislature came back into the regular session next year in 2021 and passed really progressive, really ambitious climate policies. One was a battery storage policy, establishing 1,000 megawatts of battery storage in our state so that we could ensure that families and businesses have backup for when the grid goes down. But the second thing was, and the governor led this, the governor has a council on climate change, and there was a report released in January of 2021 that included the expansion of the Green Bank's mission beyond clean energy to include environmental infrastructure. So we could now enable private investment in land conservation, parks and recreation, water, waste and recycling, agriculture, climate adaptation and resilience, you name it. The really key aspect, I think, of that bill was we now have the ability to issue a 50-year bond, which is a super power. We have yet to figure out how it's going to roll out or play, but those policies passed. As a result, our financing programs, we now allow our Smart E-Loan, which is for families who own their home, single family, to take out a loan through their local community bank and credit union. And the Green Bank supports with the loss reserve those local lenders to provide capital to families. We've been doing this now for over a decade. Over $175 million of capital has come from those lenders, not the Green Bank. We have only had to pay $75,000 in losses to support those loans from those lenders. So we want the private sector to help us achieve our public policy objectives. I could tell you, Sonia, Rob, Commissioner, our board approved of the fortified measure as an eligible Smart E-Loan measure going forward. They just did that recently. So we want to see more fortified roofs going into our homes here in the state of Connecticut. It was great, George, to hear the First Street. That's a great tool. I just went on, looked at my house, and know that I have a wind problem. So wind is a good fortified measure. So we need to be thinking about education and outreach across the board. We also, our commercial property assessed clean energy policy, we heard earlier from Nuveen, now beyond clean energy allows resilience measures to be supported through this benefit assessment financing structure. here in Connecticut as a result of Nuveen, of the Green Bank, and a number of other financial institutions. We've enabled nearly 500 businesses to receive over $400 million of investment in their properties on clean energy. We want to see that happen on resilience. So then coming back to the more recent event that we've been talking about, the severe storm in August of 2024, well, what happened in the next legislative session? We had Public Act 25-33 that passed, which the governor was speaking about flood disclosures, a lot of things around community planning, but it also included resiliency improvement districts. I'm going to follow Bhavna here and see if there are any folks here in this audience who are going to raise their hand. How many of you are familiar with a public finance tool called tax increment financing? Okay, I do. Okay, so there's some, probably 5% there, 10%. I wouldn't have expected it. Last night, we were at an event of municipal officials, and probably 50% of them raised their hand. So TIFs are a way for our local municipalities to support their economic development by using a benefit assessment structure to finance local economic development improvements. Well, as they do that, we want them to have this climate intuition so that they can begin to build into that risk mitigation so that not only are we supporting economic development and growth in our communities, but we're ensuring their resilience to the impacts of climate change. So as a part of this policy, we have resilient improvement districts, which allow municipalities to establish certain borders around certain taxpayers who can support resilience improvement projects and all pay for that through a benefit assessment, which is done for sewers, sidewalks. It's a tried and true way for local members of a community to pay for important public infrastructure. One of the innovations of the policy, we think, and we're still trying to figure it out, is the increased savings provision within this policy, which says that if you are in a resilience improvement district and projects for resilience have happened and occurred, then all of those policy holders, all of those families and businesses who are paying premiums to insurers are now better off. So therefore, their insurance premium should come down. So there should be some discount for them, and or those increased savings should go towards paying for the resilience improvements that happened to ensure that resilience, maybe covering the operations and maintenance of those facilities and the like. So we're really working to find ways for this increased savings definition to allow for enabling more private investment in resilience projects in our communities here in Connecticut.
Brian, thank you. Some great examples of the private sector help there. I'd love to sort of transition and think through the regulatory lens a little bit about sort of how insurance commissioners and directors are aligning economic and mitigation goals. But before I do that, given all that you covered, anyone care to offer any color on what Brian has shared or anything to add there?
Connecticut leads in this space. And as I travel across the country, the kind of examples that were just spoken about here, the kind of pieces that Commissioner Mais has done over a decade or so in motion in this space are the kinds of things that other states just keep looking to and how they can emulate it. And so for the rest of the country, can you hurry up?
Thank you. Bhavna, can I call upon you sort of to give us some perspective through the regulatory lens here into what public policymakers are thinking here? I'm thinking, for example, about things like the creation of potentially CAT savings accounts to incentivize mitigation spending and that kind of thing. What are we seeing and sort of what's in play, big picture there?
Sure. So we're seeing a number of things. One, to your point earlier, Roy, we're seeing people upgrading their building codes, which really is a foundational element that we need in terms of addressing climate change. To your point, Frank, the CAT savings accounts. So CAT savings accounts are a lot of very similar to healthcare savings accounts. So HSAs that many of us invest in for our health. And we're seeing it in Alabama, South Carolina, and Mississippi. And what these accounts do is you can invest in it tax-free. Your income generated from it is also tax-free. and then your qualified expenses, right? And these qualified expenses are deductibles that you would have normally paid out of pocket, uninsured losses, and in Mississippi, mitigation measures as well, right? All of those are tax-free. And these are state tax-free, not federal tax-free, although there is something, there is a bill up in the federal government, the Ready Accounts Act, which would allow the same kind of tax favorability. So that's definitely a great one. We're also seeing rate frameworks that recognize or require discounts for resilience measures, and we're seeing people pick it up, and I think we'll see more of that now after this fortified homes cost-benefit analysis that has been done. So I think we're going to see more and more of that. And then the third thing I want to highlight is innovation. So in New York, NYSERDA allocated $6.5 million to innovation in insurance. And you don't think about innovation in insurance as like propelling climate change, propelling the addressing of climate change, right? But it does. It's incredible. So Insure, which is the nonprofit that handled the grant program, has recently given a bunch of grants out, and these include feedstock supply insurance, right? So it just has these ripple effects. Embedded tax credits insurances, extended warranty for electric vehicle charging stations. So it makes it easier for people to build out these electric vehicle charging stations that then has ripple effects. Embedded parametric insurance to guarantee solar radiation levels. So it makes it much more predictable for people who put in solar panels on their homes. They know that they're going to get the cost benefit works out for them, so they're more likely to do this. So these small innovations then spark things, and then they get picked up by the private sector more forcefully. So,
thank you.
Yeah.
Brian, please.
Maybe just to follow up on that, I wasn't aware earlier, David had mentioned it from the Federal Reserve, that the CRA application with respect to resilience can be applied nationally to a local sort of event. So this notion of having a catastrophe savings account at, say, a local community bank or credit union or a national bank with the prospect of being able to utilize some of those savings for resilience to prepare for, so to invest in their homes or businesses today and recover from to pay the deductible in the event of some. I think there is a lot of innovation there that we can play into by bringing the banking industry's perspective on CRA to the most vulnerable through our local community banks and credit unions. So I do agree with the community development notion that came out earlier, that we are all in this together and we need to figure it out together.
Just to build upon that comment earlier about building codes, because I think we haven't really explained what we're talking about. We say the word fortified, and we talked about the Alabama example. And what are we talking about? It's about the roof. In most of these examples is a fortified roof. It's about sealing the roof deck. It's about your nailing pattern and drip edge. It's not a huge amount of cost, as Amy said. It's not a huge amount of cost. Some states, such as Connecticut, are already partway there. We already have a sealed roof deck in our codes. But it's disappointing. A lot of other states don't even have building codes. And so if we think about this, I think that is one aspect when we talk about return on investment for our communities. Improving those building codes for just those minor items is going to have a huge benefit. And it's also, I mean, when you think about the consumer side, when we're trying to explain to each consumer what fortified is, boy, that's a heavy task, isn't it? Explaining to consumers what they need to do, that's a tough task. I'd rather just tell them, trim the trees from around your house, please, not get into, Mom, you have to seal your roof deck. What does that mean, right? That's really tough to have that conversation.
Well, there's also, I wish it were that simple, right? It's also box your eaves and 6 inches of clear. But anyway, you know,
for wildfires, much harder.
Very complicated.
Yes.
You know, I do think it's incredibly important that we be speaking in one voice where we can to educate the property owners on what things they can do, and then what they can expect in return vis-a-vis insurance. And you know, as I said earlier, that's an evolving landscape. But right now, today, at the National Conference of Insurance Legislators interim meeting, there's a vote on a model bill that my organization has been advancing that seeks to capture the information that insurers are getting by buying drone images, right? It's aerial images that are identifying vulnerabilities in properties. And what we are looking to do through the model, and I have a feeling it's probably, it's already gotten quite a bit, I'd say, watered down, but it's still, it's a vehicle to say, okay, if an insurance company has this information, let's have them share it with the property owner. I mean, most people don't go up on their roof, so they don't know what the condition of the roof is. So if the insurer has information from these images that there's vulnerabilities, share that. So that's kind of the simple goal of this proposal, but of course the piece that's weighing it down politically is that, giving people enough time to remedy it, and insurers are concerned with, well, what if the quality of the repair doesn't meet our standard? And then finally, the piece that says, and if the property owner makes the repairs, then the carrier should offer them a renewal policy if they complete the repairs before the end of the policy period. Very controversial, as it turns out. I thought it was pretty straightforward, but that's happening today. And I still say, that it is in all of our interests to help property owners know where their vulnerabilities are and give them a chance through whatever programs we can come up with and whatever financing options we can offer, so that they actually are in a position to adapt to the way that insurers are adapting to climate change.
Thank you, Amy. I'd like to peel a couple layers back on the notion of consumer education. There is a lot there. I'm curious, what can public policymakers do, perhaps, to foster more informed consumers throughout the country? I don't know if you have any thoughts there, Bysiewicz. And then where does industry sort of fit into the puzzle? These are big questions, but as we step back a pace or two, perhaps we're in a time, given the threats that we face, where folks have an opportunity to appreciate their role broadly in the risk management process, and perhaps to think about the fact that pure risk transfer through insurance, that's not a panacea that will provide them full cover. Bysiewicz, you want to lead off there, or does anybody have a?
Sure. I mean, we can talk about consumer education again, and things like Flash that has like a buyer's guide to resilience, and improving the homeowner's resilience. And I think that's really, key, disseminating the information to the consumers and getting that out there. Amy, I don't know if you want to add to.
Look, disclosures, of course, regulators have struggled for years with how do we phrase it, how does it look. The NAIC has done a lot of work in this regard, and I think, at the end of the day, consumers' insurance is just a very intimidating topic, and they generally rely on an agent to tell them what's up, what's what. But I do think that we've got to continue to push for much more simplified disclosures that just like, for example, one of the only people I know who carries earthquake insurance in California, the policy does not just tell me what the deductible is, but it actually puts the dollar amount that I would be responsible for of a loss before my insurance would kick in. And as painful as it is for me to see that, I think it's really important that I know that, because now I know where my gap is. At least I know, well, either I should have if I had tax-free savings account option in California, which I don't yet, but if I did, that would be a strategy I could use if I were on the ball and trying to be, plan ahead.
Put insurance aside for a minute. Can we just simplify even for a minute? Where do consumers go when they buy a house? They're going to a realtor, they're going to a builder, then they're going to insurance, then they're going to a bank. And the risk signals are all different. The bank is telling you, I don't have to buy earthquake insurance. Right. Even though you're in the biggest, toughest earthquake zone there is, you don't have to buy it. And so I will give credit to the realtor industry. If you go on realtor.com, they actually have you put in your address. First Street, I think, is a foundation that provides a lot of information that at least says to you, are you high-risk earthquake? Are you high-risk flood? That's the item we have to start with to consumers, is letting them understand their risk profile to start with, Then the question is, should you buy the house in that high-risk area, right? Build a house in that high-risk area? And then what should I do for buying insurance? You know, these risk signals are very confusing to the consumers, and that's what I think we need to kind of educate better, is a unified voice to those consumers.
Yeah, and I think that there's opportunities in front of us. So Connecticut's farther along than most others in pulling these kind of elements by which, hey, what do you need for a fortified roof? How do you do this? Here's how you could get the sidecar funding to help you down that road. We don't yet have easy ways for the consumer sitting at their kitchen table to go, I just want a different outcome. If I want that different outcome, how do I get the contractor I should trust to meet a standard that you tell me makes it better, with some funding that will help me accomplish that, met by an insurance credit in my insurance product along the way? You've got to be a pretty sophisticated player to get all four of those streams to play. And so I wonder, over the next couple of years, who's going to innovate in such a way by which these pieces come together so that a consumer can say, I'm convinced I need to do the right thing. How?
I love it, Roy. Just kind of building on that, I want to commend again the insurance department for First Street. I think that tool will start the conversation from the homeowner of what are the issues I really need to be thinking about. Maybe there's a next step from there, find a contractor or something else. But secondly, one of the things we all know is that the messenger matters, right? Who do you trust? Do you trust the roofer? Do you trust your government? Do you trust the private sector insurance? Probably not. You probably trust your neighbor and your community more. So your community voices matter. And we actually see this research here in Hartford on clean energy because the city was so vocal on solar, for example. Hartford is the most equitable in terms of solar advancement in the entire country. So kind of the messengers matter, like the locality and the messengers matter in all this. But you're right, there's an innovative landscape right now. Let's leave it open to all ideas, let the markets figure it out, but let's try to get to that market transformation.
Yeah, because the consumer, I think, often ends up floating away in our innovation lake and wondering, how do I do it?
Yeah. Where's my paddle?
Yeah.
Well, it's interesting, right? Those comments sort of harken back to some opening comments that Commissioner Mais made as he kicked off the conference, talking about the fact that only by working together, can climate risk be effectively addressed. And that's essentially what I've just heard you articulate. And it's not a surprise to hear that. Our time is rapidly evaporating. It's been a fascinating conversation. Perhaps we use the last few minutes here to gaze into our collective crystal ball, as it were, and look down the road a bit. Panelists, I'm curious, if we're looking 5 years out, how will the risk and insurance ecosystem perhaps have transformed? Do you foresee significant transformation during that time period, and what might that look like? Eric, would you want to kick things off there?
Yeah, I think that we have to understand that there is an affordability gap that's going on in places in the United States. And so we have to, as an industry and as regulators and as public policymakers, evolve to think about things differently. In auto insurance, as an example, you could buy liability insurance and then you can decide, do I buy comp and collision? Why do you do that? Because it's more affordable if you can only afford the liability. In homeowners, we have this big bundled policy where you're getting building, contents, time element, ordinance and law, refrigerator, spoilage, I mean, the kitchen sink, everything's in that coverage. And the question is, should we be offering a more scaled down coverage, maybe for building only? Should there be a coverage that's instead covers your mortgage costs, or covers the value of your home? So that's one aspect. Insurance is also complicated. There has been parametric insurance that's out there that's just starting, and that's more about a trigger. If a hurricane occurs in your zip code, your policy pays out. That's it, right? And so the question is there going to be simplified approaches, maybe not the next 5 years, but over the next 10 years? And I think we, as partnership with regulators, need to think about different coverage options for our consumers.
you want to just go down the lightning round?
That's perfect.
Lightning round. I think we are going to continue to see more the excess and surplus not admitted market pick up more risks, which I think has some downsides for regulators and consumers in some ways, but it is what it is. I think we will be seeing, as Eric alluded to, more sort of micro products. So, where insurers are saying this risk is bigger than it was, and so we want to limit our exposure. I think we will be seeing more smaller, bite-sized coverage products, parametric, and that sort of thing. And I think that we will, I don't know, I think where the pressure on the developers is if that's gonna preventing more growth, in vulnerable areas and WUI areas is a challenge because it conflicts with the goal of increasing affordable housing. I think the insurance markets will adapt and rebound in a lot of ways. I'm hopeful, but I think consumers have they're not going to be seeing premiums go down anytime soon.
Thanks, Amy.
Such an optimistic thing to follow. And I said this a little bit earlier, I do think over the next 5 years we're going to find ways so that there's someone to lead the consumer through this journey. Mm-hmm. They need to understand the risk better. They need to understand how to address it. They need to understand how to pay for it and how that holds together. Lots of innovation are working in each of those individual streams. Over this next 5 years, we got to see that come together for the consumer.
Yeah, I think we're going to see broader use of forward-looking catastrophe models. We're going to see more climate scenarios in ORSAs. We're going to see more granular rating methodologies that reward mitigation. We're seeing it already in some places, but more and more. Expanded parametrics, certainly, and in New York we already have a parametric law that has passed, so there is parametric coverage out there. And community-based buyers, so these joint programs, and then growth in resilience finance.
Awesome. So let me take it from there on the climate finance front. So there are experts around the world who say that we need $6 trillion a year to confront of investment in our global economy to confront climate change. I think through 2023 we're at about 1.9 trillion. That's good. We're on a steady pace to where investment needs to be. But when you look at and we're actually seeing the private sector pick up more of that purse, which is good. But when you look at where the investment is going, 95% of that investment is going into the reduction of greenhouse gas emissions as opposed to adaptation and resilience, the other 5%. So we need to start moving that investment more towards the adaptation and resilience side of the equation so that we can address and protect ourselves. So I just wanted to come back to Commissioner Mais and Commissioner Mascaro-Bruno because I really gravitate to their we're in it together, we're helping each other sort of message around resilience and vulnerable communities. Our vision statement as an organization is a planet protected by the love of humanity. We can't have environmentalism without humanitarianism. And what we're going to need is massive amounts of capital mobilization to help our families and businesses not only reduce these emissions, but also withstand the impacts of climate change that we're all facing. So it's great to be here today.
Panelists, thank you very much. It's been a fascinating conversation. We are out of time, but it has been wonderful. Thank you.
Great. All right. Oh.
Thank you very much to the panelists for a wonderful conversation. Really intriguing things there. And as your relatively average consumer and novice to this world, some elements of that I really perked up on in terms of those savings accounts and things like that. So fascinating to kind of hear and learn about that. Lunch is on the horizon. However, before we get there, we do have a lightning session where we're going to discuss severe weather mitigation and resiliency advisory council updates. Before we begin, I just want to remind you, if you are here and looking to obtain your DRC credit, you need to scan the QR code both before and after, in order to claim that credit and fill out that form. So just a reminder of that. At this time, I'd like to welcome to the stage Robert Hodeling, the co-chair of the Severe Weather Mitigation and Resiliency Advisory Council, the Deputy Advisor for Infrastructure and Federal Funds at CT-Built Department of Revenue Services, and Sonia Larkin-Thorne, the co-chair of the Severe Weather Mitigation and Resiliency Advisory Council and a consumer advocate. A round of applause for them. Please help me welcome them to the stage.
Are we on? Yeah. I guess we are. Since we are a lightning rod, we're going to run through some slides very quickly about what we did with our Connecticut Resiliency Council. We were a group of really phenomenal and diverse individuals. We had consumers. We had the Red Cross. I guess I need to tell the slide to move. Okay. It was a group of individuals put together by the Department of Insurance under Commissioner Mais' direction. We had some of the most phenomenal people who had one common goal, and that was consumers. What do we need to do in Connecticut to improve the environment, also work on resilient homes, look at the issue of flood in Connecticut, and how do we solve the problem before we have another event in Connecticut? How do we stabilize our markets, our rates, and our availability? Rob and I co-chaired the group. However, we had Brian Garcia, who you met earlier, Eric Nelson, who you met earlier. We had Richard Brannigan from the American Red Cross, and people said the Red Cross, remember, every time you have a catastrophe or a major weather event, it involves the lives of people. That's a heartbeat that you always need to keep at the forefront of your thoughts. We had Jim O'Donnell from CERCA, the professor of marine sciences in Connecticut. We had Joanne Wozniak-Brown, from the office of CTOPM. We had the reinsurers with Matt Wolf. We had George from the department, my biggest nemesis, but who always reminded us of what our goal was. I love that guy. But we had a group of people, and we had a group of advisors that were beyond reproach. When you think about it, we had the Department of Insurance staff in its entirety there to work with us. Phenomenal people. We had extra folks from the Green Bank that Brian made available to us. In fact, he made his entire staff available to us. We had people from the University of Connecticut. And for those of you who don't know, the University of Connecticut has the greatest group of environmental scientists you ever want to meet. They taught us about trees. They know where tree exposure exists in the state of Connecticut. We talked with Habitat for Humanity, and I know Chris McKeevy couldn't be with us today, but the work that they're already doing on fortified roofs and houses. We also had in our group Jim Parrish from the Builders Association. They told us about what was available in terms of skill sets in Connecticut. We had Safe Homes, we had the NAIC, we had IBHS, we had Flash. We managed to touch literally every group, organization, or person who could provide us information on how we could make Connecticut a safer place and how better to deal with catastrophes. But more importantly, how to address consumer concerns and consumer protection. We came up with a series of recommendations, and I'm just going to rush through the first three. We recommended that we partner with existing mitigation and resiliency programs, the Connecticut Department of Housing, Habitat for Humanity, and in fact, Habitat for Humanity has already built a series of fortified homes in East Hartford, and a number of us will be reviewing those homes tomorrow. The Red Cross, and people said the Red Cross deals with the aftermath of a catastrophe, of a weather event. Like I said earlier, the UConn engineers in their environmental space, these guys and gals are phenomenal in terms of the information they could bring to us about where the risks were and are in Connecticut. One of our core recommendations, which you heard the other panel talk about, the previous panel, was launch an education and communications campaign. This is core to making a change in the mindset of consumers regarding the need to engage in protecting their single largest investment in this country, and that is their homes. What consumers don't know about catastrophes is scary. What they don't know about their insurance is even scarier. What they don't know about the need to purchase a flood policy and where to even find one is even scarier. So as we looked at that, we look at what the Department of Insurance has just released in terms of their website and what risk your home is exposed to today. They're going to expand that information as they grow on this issue. We know that agents are a core group of individuals we all need to be working with and making sure that they can educate their policyholders or their potential policyholders. Insurance companies, you play a tremendous role in this area, and we have to work closely with you for you to help us get that information about risk out there. The cities and towns, and we're going to see that tomorrow in East Hartford with Habitat for Humanity and the mayor of East Hartford talking about the project that they jointly developed in their city. Consumer organizations are another critical component of educating consumers. We even list in our report churches, schools, anyone that touches the heartbeat of an individual out there who has to protect their single largest investment, their home, we need to be touching base with to make sure they have that core material needed to educate their friends and their families on the risk of catastrophes and the need to fortify their homes, the need to address their flood risks. Our third recommendation was to pilot an IBHS fortified mitigation program, and George Bratner is working on that now with a group of individuals. He brought IBHS into our work group, our advisory council, and they did an enormous job of educating us. They've already created this wheel. We just have to jump on that bicycle and ride with it and bring more of that information into Connecticut. But again, the example is to work with the Habitat for Humanity group of Central Connecticut. I can't emphasize enough. They have already built fortified, already certified roofs. They're doing it. We just need to join their team. Again, work with the information that is already out there. I was amazed at what I learned about what UConn, the University of Connecticut, is already doing in this area when it comes to resiliency and education and what our exposures are. The information is there. We don't need to recreate recreate anything. We just need to join together to work with them to educate our towns and our town engineers and our mayors, and more importantly, the biggest group, our legislature, on what we need from them as part of our team to invest in Connecticut. Rob?
Yep, sure, thank you. And I've done a number of these events, so I know when you're in between the crowd in the food, you got to keep it quick, right, Commissioner? So I'll be very efficient here. Recommendation 4. So this is really about the expansion of the IBHS Fortified program and expansion of the Comms and Ed. As you heard earlier from Eric, who was a great member of our team, explaining, well, that's, I think, where we could all help. It's not just waiting for the state or the federal government, but what can we all do to help? And what we're proposing, the council's proposing, is $105 million over 10 years. That would be, once those are secured with the necessary legislative approval and full funding, then we can embark on this comprehensive statewide plan. And a lot of it was based and modeled off of the successful Alabama program, as you guys heard, where we heard from the prior panelist, Bhavna. Great numbers she gave. For every $1, 13 in catastrophe savings and 33 in economic impact, right? So that's pretty important. So although we're saying 900 to 1,000 homes, we're being conservative. George and I went back and forth a little bit about that, I think. But the point is that it creates a culture of resiliency, which is what Alabama did in strengthening the homes, and we saw that in other states as well. The other point, too, that we want to make on this as we go forward is it's a declining incentive model. which we saw that, and I had a prior honor of being part of the Green Bank's board, incredible organization, love Brian and the whole team, Lee and everybody. That was catalytic investment. So it starts with the state, and then as other folks continue to, the private comes in and other people start to get that benefit. As you saw, again, Alabama, their program is only 17% of the homes covered. That means everything was market-based, right? It's a market-based solution. So, okay, next recommendation, recommendation 5. We want to incentivize home mitigation through tax credits. I have the great honor of both being a deputy commissioner at Department of Economic and Community Development, but now I'm a deputy advisor for infrastructure and Fed funds at DRS. So I went from the good guys who give out the money to the bad guys who collect the money, but it's okay. You can still talk to me if you'd like. But the point is that the tax credits, there are incentives that we believe would be really impactful, especially with the FEMA and the uncertainty. Again, with federal funds, there's a lot of uncertainty. I think there's a lot of folks who just assumed, especially with flood, FEMA will come in and save me. I think people are now getting that signal. We heard a lot about signaling. I think there's a different signal now from the federal government. We need to start thinking about what we can do and be augmented by the federal government, not have the federal government lead. And we believe that tax credits are one way to incentivize property values, stimulate the economy, encourage insurance credits, and reduce the state disaster relief burdens. All right, let's move to the last one. As you heard earlier, again, Bhavna explained this pretty well, what a catastrophe savings account is. In Connecticut, we did propose one. What we're proposing from the council is expansion or broadening of that eligibility. We really believe that the council, that every homeowner should have access to this for various reasons, right? And you'll see here, it's really those pre-tax dollars that could be applied to those catastrophe events. So this would incentivize proactive mitigation investments. It would reduce reliance again on state and federal aid post-disaster. And it would really empower those residents to do more. The last part, jumping to the conclusion here, since I think I don't know how much time we have left, maybe a couple minutes, is that, okay. It shows green, that means I have more time, right?
Keep talking.
Right? Okay, perfect. I may not be as good as Conor, but I'll do my best. So we want to further the study. One thing we did realize, and very appreciative to Commissioner Mais, Jared, the whole team, for calling upon Sonia and I. We've become like BFFs, right? You know. But we realized we didn't get enough time and we want to do more. And this is just a start. The main thing that we wanted to focus on, and we talked about this, we talked about the commissioner and the deputy commissioner, is we want a plan of actionable steps. You heard this from the commissioner when we opened. You heard it from the governor. We want to make sure it's not just a report with nice information. What can we actually do to take action now? And so we saw the recommendations. I think they affect every single person in this room, not just here in Connecticut, but again, that wider economic market. Because materials come from outside of the state, right? That affects businesses and supply chain, builders, right? That's economic incentive, and most importantly, our residents and small businesses. Our report focused on residents and consumers and homeowners for now. But small businesses are key drivers to the economic activity of our state, like any community across this great nation. So we want to be able to address that at a future date with the proper time and focus. So those are the things where we want to further to study those. So in conclusion, we want to make sure that we apply the proper risk expertise to this, and I think everyone in this room has some level of expertise. We want to make sure that, again, we have an actionable plan with set of steps that we all can contribute to. And then instead of the question fundamentally of what can they do, what can I or we do in order to make a dent in the resiliency proactiveness there. So again, as you heard earlier, and I'll conclude on this, that Naugatuck Valley event last year was a real eye-opener for a lot of people in the state. And we realized, whoa, anything can happen. It's a 1 in 1,000-year event. Regardless if you believe in climate change or not, you can't deny severe weather events. Severe weather can happen in any community almost at any time. And so, and I want to clarify one last thing too. People ask, why is the name so darn long, right? I've heard this. God, like, you know, severe weather, mitigation, resiliency advisory, but there's a reason. Mitigation typically is what can we do before the event, and resiliency often is what can we do after. We wanted to make sure we had a holistic approach to what we're talking about under the guidance of our great commissioner, and we believe that our recommendations really do that, and it goes a long way to that. So, and again, we want to thank everybody, both our CID staff. Thank you, Sonia, as my co-chair. Thank you to all the members, and definitely thanks to everyone who contributed and the public who gave their opinions in order to put together this recommendation. Last comment, I got this from Anna and others on the CID team. They said that it may not be on the desk. We wanted to put QR codes to that report. But I understand you're going to get a post-email after this event, post-event email. Yes, Jared? He's nodding his head in approval. We understand that they're going to put, I'm putting them on the spot right now, they're going to put a link to that report in that email so that all you guys can read it and really understand what we're trying to propose. So anyway, thank you to everybody.
Or you can currently go to the department website where our advisory council is listed and find the report there. But as Rob has emphasized, and I want to emphasize, this is a partnership. We all benefit when we all work together to address this concern. It is an ongoing concern. It's not going to go away. It's going to be with us forever. So whatever you can do to partner with the Department of Insurance to read our report, to support any legislative activity that will occur during the next legislative session, to look at these issues seriously, because you, as an industry, are as invested in this project and in this issue as we are as consumers. So join us and be a part of the solution that we can drive in solving or addressing this issue. We'll never solve the problem of climate. It's going to be with us, but we can solve the problem of consumers being unprepared for the event. So thank you, Commissioner and the staff and all of the support that you gave us on this. We look forward to continuing this, and I hope to see every one of you at the legislature when it reconvenes, not the special session, but the normal session, to support the department and their activities and their need for enabling legislation to keep moving this agenda forward. Thank you.
Thank you.
Thank you very much for that lightning session, Robert and Sonia. We appreciate it. At this time, right before I break you for lunch, a couple of housekeeping notes to remind you, and then you can go enjoy some fine food out there in the lobby space. A reminder that we have an art exhibit. If you're looking at the stage, it's going to be to your left, my right, almost through those double doors. Please take an opportunity to stop and check out some of the amazing work. We have Max Geigel here, who did a wonderful job. I see Max in the back. Hi, Max. As well as Abhijit Srivisava, who came up from New Jersey, and I had a chance to look at the exhibit, and it was really wonderful. Again, just to re-mention the tables that are along the back as well, too. You can stop by, play a little Plinko we got back there at the CID table, which is fantastic. Our friends at Nassau Financial Group have those kind of the disaster kits for kids. I was able to fill some of those bags as well. It only takes a moment to make an impact. And as an incentive, I put a couple of my personal souvenirs back there that you can enjoy, maybe get some pictures with. They're very shiny. And if you're a UConn fan in the house, you might want to stop by. But you can only get them and check them out if you do at least 5 of those kits. Lunch is 1 hour. We'll return just before 2 o'clock. I'm sure I'll have some sort of a warning out there in the lobby as well. But thank you very much for joining us for the first portion. We appreciate your attention. Let's go have a great meal. Thank you.